is important.
Looking forward to that, Tom. The dollar stronger, of course, through the months of August, taking down sterling, taking down the euro in and around parity. But TK, what a month for risk assets in the month of August. Stocks down, commodities down, corporate credit down, high yield suffering, treasuries down. Take your pick. Brutal month, particularly the end after Jackson Hole.
And convexity, or fancy talk, acceleration in bond yields. First thing I looked at yesterday, John, first thing I looked at today, the German 2-year yield legs up as we see Asian currencies leg down to new weakness.
It has surged over the last month, and we'll pick up on that theme in about 30 minutes' time. We can pick up on the theme of the ECB. We've talked a lot about the Federal Reserve. Anna Edwards, look at this for a list. Goldman Sachs, Bank of America, JP Morgan, Capital Economics, Bloomberg Economics, all looking for 75 basis points from this ECB next week.
Yeah, absolutely. It's hawk after hawk, isn't it? Is Philip Lane the only, I was going to say the only dove standing, but I don't know if they stand flying. But he's certainly been the only major voice out with fairly dovish comments, flagging Italy risks, flagging that if you go slowly with hikes, you can correct course. But others aren't giving us those views. They're just hawkish.
And Anna, willing to do this going into a recession. I keep saying potentially a recession. Do you just consider that a given? Because most people looking at this situation see it that way.
Yeah, I mean, a lot of guests do flag that they see recession coming, but still big questions, though, John, obviously, about how long those last and how deep it gets. And frankly, a lot of it comes down to the weather and how therefore, the economies manage to sort of weather the weather, if you like, how they can cope with the cold. As gas, yes, it's stockpiled, but that's not going to be enough.
We've said a few times, winter has already arrived for the Europeans, Tom. We talked about Europe, the US, let's do China. 20.9 million residents locked down in Chengdu. If you thought things couldn't get any tougher, Tom, there's some extra fuel for the fire.
There's a war in Europe. We forget about that. And frankly, it's not funny right now. On two fronts in Ukraine, John, it's an active war this last week of Asia. It's not a war in China. It's a war on common sense and science. And it collapsed overnight in Chengdu, 800 miles in from the Pacific Rim.
Tom, we're taking it back to the Cold War in Europe. We're taking it back to 2020 in China. We've got a pandemic, got a war, got the United States stuck in between, trying to raise interest rates, get demand softer, get inflation down. Tom, that's a lot of conflict. A lot of conflict to try and digest, process, and work out what it means for this market.
Currency will adjust part of the inflation. It's a partial differential on inflation dynamics, but nothing will bring inflation in, John, like weak growth, the global slowdown we see. And that's what you heard this week from, example, David Rosenberg.
That's the #1 question to ask, though, Tom. What is the GDP price we've got to pay to get inflation lower? What's the price?
I agree with that, and to see dollar Canada out near 132 is absolutely stunning today. Why don't you bring in our guest, John, or do we need to do data?
I was going to do the price action first, Tom. You know how this show works. Welcome to Bloomberg Surveillance. Futures down 0.6% on the S&P. On the Nasdaq, we're lower by 0.9%. Yields just a little bit higher, not much higher. 320 earlier this morning. Right now, 319.46. Backing away on crude, down by more than 2 percentage points. 87.45. Talked about sterling being weaker. The euro is as well, down a third of 1%, negative a third of 1% on euro dollar to 100.19. Jean Barvan with us now, the head of the BlackRock Investment Institute. Jean, I've been following your research, your writing, you know I do, and I'm pleased you're writing on something that I don't think enough people are thinking about, the appropriate time horizon to bring inflation back to target with the circumstances, the backdrop that we have at the moment. John, what is it, and why aren't we talking enough about it?
There used to be, I'm old school, I guess, but there used to be two key principles underlying monetary policy. One was that, you need to be thoughtful about dealing with trade-offs and being deliberate around that. And the other was about being forward-looking. Those two principles seem to be pretty much absent from the current discussion. And I think that speaks to the horizons here. We're dealing with a massive shock that is more of a supply in nature. And that leads to, we're just talking about how much GDP costs we need to go through. We think the GDP cost is pretty significant. If we want to bring inflation down to 2 quickly, it's 2% of GDP, recession type we need to go through in short order. That's a very brutal cost. And nowhere in the discussion right now you see this explicitly being acknowledged, being discussed, or hearing from central banks on how they want to navigate that. we used to think that in the face of these shocks, it would take longer to bring inflation back to target. Nobody is really making this argument.
Jean, I want you to talk about the asymmetries there of strong dollar versus weak dollar. Now we have strong dollar. I'm not going to ask you for a level on your Canada on loonie at a 132, but what is the asymmetric differences of a bold, strong dollar versus a weak dollar reality? We don't have that right now. We have strong dollar. It seems new.
Yeah, I think we always break that down in terms of what we think is the key driver. Think of the currency being driven typically by two broad regimes, in my view. One is interest rate differentials, and the other is the broad risk-on, risk-off global sentiment. I think we're in a world now that is mostly driven by overall risk sentiment. So I see the gyration being about whether we are risk averse, which tends to provide a bid to the U.S. dollar, and that when that wanes, we see some weakening. So I think we haven't seen the full implication of this world yet. The pressure is going to put globally. Canada is one place, but like emerging markets. So that hasn't really played out yet.
Right.
I think that's part of
the picture here. I wanted to go there because Aussie yen is out 1.5 standard deviations, which is a rare occurrence. Tell me of the Pacific Rim risks that we face now, or are they in some way protected from the tumult in the Western world?
No one is protected, but I think there's homegrown kind of headwinds, right? That we see. We were just talking about lockdowns in China, so the pole of growth there certainly has been challenged. We've been neutral on the region for some time now as a result of this, and I think a global recession or slowdown that would be significant will have some rippling effect there as well. So I think we see these part of the transmission of the slowdown through the APAC pole of growth.
Jean, good morning from London. What are the, good afternoon even now, time catching up with me. What are the monetary policy lags that we need to keep in mind when you're talking about the tightening of policy as you are there, and you're talking about the time horizons over which we should be correcting inflation? What are the lags in policy that you have in focus? I mean, I'm thinking here about the US.
So we, in general, I think we're still in the world where like monetary policy works with at least a year to 2 year of lag. 18 months is the number you would get from typically if you pin me to one number. I think that still is the case in this world, and I would argue that it might be even more delayed because the interest rate here is not the cure for the source of the inflation we're experiencing. So we will need to basically crush the interest rate sensitive part of the economy, which is not the culprit of the inflation at this point, to really offset the other inflation pressures. And so that needs to work its way through the system. None of the rate hikes we've seen so far are really containing inflation. We're getting now to the phase where it's going to be restrictive. It will have an impact, but that's going to be about a 2024 story, really. And that's why I think we see a lot of optics of central banks talking tough on inflation. But this is really optics and politics of inflation, not really the economics of inflation.
So, Jean, let's talk about what it would take for you to get bullish on this equity market. Jean, what do you need to see?
We need to see a couple of things, right? I think now we're... equities and generally are reflecting a path of policy tightening that is more or less in line with what we think will materialize. So, Jackson Hole has, I think, crushed any hopes of backing off from hiking intention soon. I think equities are starting to reflect that properly. The part that is not yet in the price is the earnings story. And, we think we're going to see a recession early 2023. In the U.S., but it's happening earlier and deeper in Europe, and that is not reflected in the equity price. So to turn bullish, which will be the big call to make over the next few months, is when we're going to be able to start to look through the size of this recession and have more handle on this. And the second is when we get to the point where we get some sense that central banks are waking up to the damage that is being caused and are starting to take that into account. So when we're going to start to see sign of that, I think we'll be now in a position to really talk about a version of a pivot or slowing down or stopping. And once we have visibility on this, then I think that's going to be a more positive backdrop.
We'll catch up soon on it. John, really deeply Thoughtful stuff. We appreciate it. Jean Bavon there of the BlackRock Investment Institute. Just a couple of things to look out for in the day ahead. I'll pick two for you. Jobless claims coming up at 8:30 Eastern Time. Mike McKee, as ever, is going to break that down for you. The estimate on jobless claims this morning, 248K, up from 243. That's the estimate in our survey, so look out for that. Then later at 10 a.m. Eastern Time, the team's going to break down the ISM manufacturing number.
Yeah.
And a little bit later, the estimate there, 51.9. The previous read, 52.8. Remember, the S&P Global PMI, dreadful. We'll see what the ISM looks like. And then, Tom, it's on to payrolls tomorrow. You mentioned the estimate of 300K. I can tell you it's coming just a little bit to 298.
There's a little bit of a change there. John Sterling out to new weakness moments ago.
I saw that, Tom. Lower the session, 115.54. Coming up, Marvin Lowe. We'll catch up with him at around about 8 a.m. Eastern Time. So let's call it 50 minutes away. He joins us from State Street, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. Former President Trump has accused the Justice Department of criminalizing his possession of personal documents. He made the allegation in a court filing seeking to bolster his case for a neutral third party to review documents seized by the FBI at his Florida home. The agents were investigating the presence of hundreds of highly classified White House records. In Alaska, Democrat Mary Peltola has defeated former Governor Sarah Palin in a special election for the state's only seat in the House of Representatives that widens the Democrats' narrow majority, and it sets up a rematch with Palin in November for a full term. Peltola's support for abortion rights was seen as one of the deciding factors. Friday's U.S. jobs report has the potential to tip the scales towards a third jumbo-sized interest rate hike later this month. It's one of the last big releases that Fed officials will have in their hand before their mid-September policy meeting. There's already been a wave of data that point to a resilient consumer and high labor demand. In the UK, Liz Truss made a couple of eye-catching promises in her final pitch to become the next Prime Minister. Truss, who's favoured over Rishi Sunak is the Conservative Party leadership race, ruled out introducing any new taxes or energy rationing this winter. The next Prime Minister will be announced Monday. And Lufthansa says it will cancel almost all flights to and from its Frankfurt and Munich hubs on Friday. That comes after the German airlines pilot union called for a one-day strike. About 800 flights and 130,000 passengers will be affected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
Hearing from central bankers and academics around the world, the clear priority was bringing inflation down, and that really lines up with my own priority, being president of the Dallas Fed and as a policymaker. Our number one priority has to be to restore price stability.
Fantastic to hear from Laurie Logan of the Dallas Fed, the new president, making her first address, Tom. Very, very cool. Congratulations to her. Live from New York City this morning, a good morning with Tom Keene and Anna Edwards. I'm Jonathan Ferro. Bramo's going to be back with us on Tuesday. Looking ahead to payrolls, this is the number we're looking for, 298. The previous number, 528. Going into it, futures down about 0.5% on the S&P. On the NASDAQ 100, down 0.7%.
It's terrible.
Yields unchanged on a 10-year, very close to 320, 319.84. Dollar stronger.
John, it's just terrible.
Euro weaker, euro dollar negative 1/3%. Crude down 87.70, down 2%. What's terrible, Tom?
Fully employed America. I mean, it's just,
Well, this is the issue.
Terrible.
I'm with you, so let's discuss it calmly. How do they convince people? And how many times have I asked this question, Tom, in the last week? 50 times? How do they convince people higher unemployment is the price worth paying to get inflation down? How do they do that? Now, at the moment, with unemployment at 3.5%, the objective might not sound as controversial, but once they get there, Tom, and you start to see unemployment climbing into year-end, which is in the forecast of this Federal Reserve, what's the reaction then?
I think the real estate issue is tangible. Other than that, I would suggest second-order conditions will solve the problem, including if price comes up, it works to bring price down.
I hope that's the case, Tom. Without a big GDP hit.
Anna's like,
that's the case.
Anna's saying, like, why did I sign up for this show? Yeah.
Most people feel that way, TK.
I wasn't saying that. So I was just reflecting on what we heard from Jean Boisin just moments ago, where he was talking about how long it's going to take to bring inflation down.
Exactly, that's it, Anna.
It's really important, isn't it? How long is it going to take? Yep. And drawing out the different drivers of inflation, and in this particular context, when some of it comes from supply, you weigh down on demand, but that doesn't fix supply.
I would just suggest, John, that the British do that better than we do. The British do x-axis analysis way, way better than the heritage of U.S. economics. Let's take us to politics right now. Jack Fitzpatrick pulled the unfortunate straw. He's going to talk about second choice voting. But first, Jack, before that, I've got to go to Alaska and say that the geography lesson for today is Kansas, the Hudson River north of New York City, and now the great state of Alaska with one congressional vote. Is the vote in November just about abortion?
It is a huge factor going into the midterms. The Alaska race does seem like some evidence of that. The Democrat who just won that special election, Mary Peltola, played up her opposition to the Supreme Court ruling pretty significantly. It is a little hard to draw inferences nationally from a ranked choice race where you had a Democrat in Alaska beating someone like Sarah Palin, who is a bit of a lover or hater politician and didn't get a lot of second choice measures. But it's a huge factor, especially for any Democrat running in the midterms right now.
Jack, I can say this on the British Hour of Bloomberg Surveillance with Farrow and Edwards here today, but ranked choice or second choice voting is un-American. It's something new for us. And obviously the Democrat won the second time around, going from 40% to 51%. Did Palin lose the election because of ranked choice voting?
Potentially. One, the Democrat, Mary Peltola, got the most votes for the first pick. If it were not ranked choice voting and they went to a two-person runoff, it would raise the question of could Palin consolidate the vote that went to the other Republican, Nick Begich. In this case, people listed who their second choice was, and only barely more than 50% of the people who voted for that other Republican gave that second choice to Palin. While the rest were split between either giving it to the Democrat or saying none of the above.
Beautifully, Jack, just because of time, beautifully explained. Anna Edwards, this is more crazy than British politics.
Yeah, that might be. I was actually drawn, Jack, to some really interesting statistics over recent weeks that showed just how many women are coming forward to register to vote and how the number of women outpaces the number of men coming forward to register to vote. So if you're looking for, across the United States, the impact still of that Supreme Court ruling is there, isn't it, in that statistic? And some of that is in some swing states, so this could still make a difference.
Oh, it can make a very significant difference. I'm sure it will make a difference. It's a hugely motivating issue for women, for Democrats. It's not something that plays to the same degree of motivation for Republicans. There have been other statistics. You look at some of the generic ballot polling that's looked good off and on since that Supreme Court ruling for Democrats. The question is, how good news is it for them? Where does it help them the most? Is it in the key swing districts? And are we talking about Democrats actually having a chance at winning the House, or probably more likely losing by a narrower margin and holding on to the Senate? But it's a very significant thing in some key races. Nationally, that is probably the biggest factor playing in favor of Democrats and motivating Democratic voters heading toward the midterms.
Jack, thank you. Jack Fitzpatrick there, down in D.C. That's the domestic politics covered. We need to talk about the international issues. A report came out from the UN yesterday evening, a much anticipated report, and it concluded something deeply distressing, Tom, which we've discussed many times over the last few years. The UN says that China has committed, quote, serious human rights abuses. They went on to say that their assessment found, quote, patterns of torture or other forms of cruel, inhuman or degrading treatment or punishment. Of course, you're all familiar with the region of Xinjiang and what's been happening with the Uyghurs and other Muslims as well. The report went on to say, Tom, there was a broader campaign of rights violations that, quote, may constitute international crimes, in particular crimes against humanity. These allegations also leveled by the previous administration and the current one as well, Tom, here in the United States. This was Beijing's response to all of this. They're calling this, quote, the lie of the century. They're going on to say that it wantonly smears and slanders China. And the foreign ministry calling the report, quote, Tom, illegal, null, and void. But I do wonder how this administration responds to this, Tom. in the coming days, and I haven't seen a big response to it just yet.
I think the simplistic response is we need our iPhones from China. I mean, this is about the fallback on this, John, is the globalization and trade relationship, as Catherine Mann, now with the Bank of England, brilliantly put, the dysfunction of our trade relationship with China. That's the raison d'etre for why we're doing this. I would point out it is the bipartisan issue of Congress, not it's the.
That was the multinational response to things in Russia over the last 10 years, Tom, and then things broke.
And 20
we need our gas from Russia, and here we are, and it's going to be interesting to see how multinationals respond to this too. Live from New York, this is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Choppy start to the month of September. Good morning to you all. Live from New York City, futures down 0.5% on the S&P, on the Nasdaq 100 down 0.7%. Over the last 4 days on the S&P, 4 days of losses that total 5.8% on the S&P 500. For the month of August, commodities lower, high yield credit lower, Treasuries lower, equities down, brutal across the board. Thank you to Lou Wang of Bloomberg News for breaking that down as yields push higher and eat into this equity market. Up about 60 basis points to the front end through the month of August on a 2-year, breached 350 a little bit early this morning, broke through that level. Right now backing away by a basis point or two on a 2-year, 347.89. Yields problematic for the equity market. I can tell you yields doing nothing in Europe to help the FX market. So let's take a snapshot of that in Europe. Sterling and the euro over the last month. This is over the last month. Let's pay attention to this. Yields have broken out by more than 100 basis points on a 10-year gilt. Yields have broken out on a 10-year bund by about 80 basis points over the last month. And typically you'd think with those kind of moves that maybe you'd get some kind of currency stability. Here's the problem. You haven't. Euro dollar negative about 2.5% over the last 30 days, Tom. Sterling cable at 115.69, down 5.5%. We have just had the worst month on sterling against the US dollar going all the way back to late 2016, even with a massive move in yields. The why? Well, we're talking about how are you going to attract that foreign capital into the UK?
Exactly.
Do you need higher yields, a weaker currency, or both? If this new government, Tom, needs to offset some of that pain because of the energy problems.
And John, what's so important here, I'm going to channel Robert Sinch 101 from years ago at Bear Stearns and Bank of America. There's a point where you switch from interest rate analysis to flow analysis. Are we there where these flows in and out of UK based on worry really matter?
Kit Jesus Sock, Jen. Stephen Gallo of BMO, the former Deputy Governor of the Bank of England, Charlie Bean, speaking to us just yesterday in the London team. They're starting to think about those issues in a bigger way. That's the UK. For Europe, Tom, we're talking about 75 basis point hikes from the ECB, according to Bank of America, the likes of Goldman, Morgan Stanley, take your pick, Capital Economics, Bloomberg Economics, all starting to lean in that direction, Tom, and still we can't get any real traction in the currency. They're two really important things we need to look out for through the next couple of weeks, Tom. The ECB on deck next week, the Bank of England soon after.
Well, and also the economic data as well. These inflation numbers, John, are unimaginable.
Tough, and that's why they want to make a move and do something about it with higher interest rates, but the currency story is not helping, that's for sure. Let's across asset price action. Let's get you some single names and movers. We can do that, I'm pleased to say, with Critty this morning. Hey, Critty.
Well, good morning, John. You're talking about the currency story. Well, it extends into Asia as well, specifically circling right back into those chip names, and that's really where you're seeing the pressure this morning. NVIDIA in particular, of course, the major tech heavyweight and the major player in the chip space, down about 4.5%, dragging down the entire chip sector with it. And here's why. There is a triple whammy. Some of that is going to be the currency story. It is, Tom. There's no other way to say it. The second is going to simply be there is that China lockdown in Chengdu specifically, which is going to be a major tech hub. So it's going to start to affect the supply chains of a lot of major American tech companies. Once again, really pressuring this sector. But really, I think the cherry on top of the pretty bad Sunday for NVIDIA specifically is the warning that they gave. You now have the U.S. government putting restrictions on exports, chip exports, especially artificial intelligence related to China. If a company like NVIDIA now wants to access the Chinese consumer, they have to get special permission from the U.S. government. That warning, they said, could actually hurt their bottom line by hundreds of billions of dollars in revenue. So a lot of pain in NVIDIA, and it is rippling across, to Advanced Micro Devices, down about 2.5%. Micron, the largest memory chip maker in the States, also under pressure, down 1.7%. You even see it in the names like Intel, for example, which, by the way, just broke ground on a new manufacturing facility in Ohio, something that President Biden actually attended himself, still not immune from the pain, down 0.9%. Right. Bed Bath & Beyond, Tom, a favorite of yours, I'm sure. When you talk about the retail sector, they have this massive turnaround plan. Liquidity is still an issue, though. A 27% drop in yesterday's session after they said they might actually sell quite a lot of stock. The hangover is not over for that stock, down 3% in pre-market trading, but a pocket of green, Tom, when you look at 3M specifically. Now, what's interesting here is the shares are actually up about 0.4%, This follows them talking about massive job cuts and job losses. What's interesting here is ordinarily on the surface, that sounds like bad news, but this is a similar reaction we saw in SnapShares as well when they announced a 20% cut to their workforce. The idea of cost-cutting measures is something a lot of these stocks are being rewarded for.
Critty, thanks so much. Greatly appreciate it this morning. Futures negative 13. We had a 27 handle on VIX, gets my attention. This morning, we're looking at oil. Francisco Blanch scheduled to be with us. Amrita sent earlier. And on this lazy August summer week, well, it's not. We are thrilled to bring you this morning Ian Lingen, he is head of U.S. rate strategy, BMO Capital Markets. His morning note is definitive on Wall Street. Ian, what nobody's talking about, and I want you to do this for John Farrow in The Real Yield that will be filmed tomorrow in Panavision. It is the inflation-adjusted yield creeping out up. What are the ramifications if the real yield breaches through its previous high?
Well, I think that the real yield story is a very important one given where we are in the cycle. We're seeing break-evens start to compress, which means compensation for investors to move further out the curve is going to remain under pressure. If you get real yields back at the highs, that means that financial conditions are going to be tighter. It also means that the Fed's actions are becoming more and more relevant to the real economy. So that's certainly something we've been watching very closely.
Is the real yield, as it moves, and frankly, after the jobs report, and when John films in Panavision on Friday, is the real yield something that can change what Chairman Powell and the Fed do?
I certainly think it can shift the cadence of their rate hikes, but it won't define whether or not they're going to continue to hike at every meeting for the balance of this year.
How far do you think the Fed goes here, Ian? And I ask this because I saw in your notes you talk about how they're more likely to overshoot than to show restraint. When do we get a sense of that overshoot?
So I think at the next Fed meeting, you'll get the updated SEPs or the dot plot, the projections. The Fed will tell you where they think terminal is. And at that point, all else being equal, I suspect they're going to err on the side of targeting the 3.75 to 4% range by the end of the year. More importantly, though, they want to hold that as long as they can. And we've already heard that rhetoric from Jackson Hole and some of the other Fed speakers. They're going to get to terminal, and they're going to hold it ideally through 2023, if not into 2024. The big question becomes, will the other financial markets allow them to do that? And we suspect the answer is ultimately no.
Okay, so it's a hike and hold, not a hike and cut. What's the read across from other international bond markets? Because we've been talking about whether there's a risk premium increasingly coming into sterling bond markets, to gilt markets. We're talking about the challenges facing the Eurozone economy. What's the read across from these markets into treasuries?
So in terms of how it impacts the treasury market, there has been global upward pressure on rates, but to some extent, if you have the ECB going 75 next week, that's going to impact global commodity markets a bit more and to some extent take the heavy lifting burden off of the Fed. So in an environment where one might foresee the Fed getting above 4%, say to 4.5%, if everyone else is hiking as well, then that makes it a bit easier for the Fed to target a lower terminal rate and then keep it there for longer.
If I look at the Bloomberg, the Lehman Barclays Bloomberg Total Return Index series, the fact is we're rolling over, price down, yield up. If we breach the lows, is it like equities where bonds in aggregate have a convexity trend of fear? Do bonds, Ian, we don't know this because we haven't had a real bond market like this. Do we get convexity and fear and sweat and catharsis acceleration in bonds like we're used to talking about in equities?
So I don't think that we're going to see a wholesale capitulation comparable to what we often see in the equity market. And a lot of that comes down to the fact that the people or the institutions that hold treasuries are major central banks, they're major buy and hold investors, insurance companies, et cetera. And so they don't have the same, or don't necessarily have the same incentives to get out and realize those losses that an individual might have. They just take the loss. Exactly.
Ian, I want to squeeze this in before you run because we're lucky we've got you here in New York. Tom and I now have got a long list of people who think we've seen the highs on a 10-year for the year. Steve Major of HSBC, I can think of a ton more. Ian, at 320, what's the risk around that view?
I still think that we have seen the yield peaks for the cycle, but it looked a lot more of a compelling argument when we were at 251 just recently. It's certainly going to be an interesting next 2 or 3 weeks in the run-up to the Fed. If we break 350, it will be between now and the 21st of September, and that'll be a massive buying opportunity for a lot of investors.
There we go. Ian, thank you. Ian Lingen there of BMO Capital Markets. Tom, the high of the year on the closing basis, 347.33. That was on a 10-year. That was back on June 14th. Right now, just south of 320.
Now, John, I'm bringing in the duration. I'm bringing in the level here on my triple leveraged all cash fund. I mean, I've just got a shortened duration.
You putting some money to work, Tom?
No, I'm putting it to sleep.
You're putting it to sleep.
Yeah, I'm just running away.
Okay.
I'm short in duration of my cash account.
What are you doing? How much shorter
Reading
can you
Fibozzi.
get? How much
This
shorter
weekend-
can you get? Have you seen what T-bills yield, Tom?
I don't know. I'm just hedging out here.
I think someone's trying to guess the first word news.
I think they're trying. Tom, that wasn't for you, John. That was for me. That was for me. Can you do that again in the studio? We need that here. We're waiting here. John, I'm waiting. Come on, give me a first word. Let's go. Let's go.
For anyone on radio, that's a visual cue for us.
Yeah, it's a visual cue. Yes, on radio they're in our ear. Tom, shut up. And on TV they put up the first word banner.
They're not doing that again, Tom. I'm going to whip through the price action. We're off the lows. Things get a little bit better. We're down about 0.4% on the S&P. On the Nasdaq, Tom, we're down about 0.6%. Yes.
John, the interns are gone. I'm looking over here. The interns are back in college.
They're back in college. That's
I
very
need some Tang, and I can't get it.
We've had enough Tang already. Did you see the US Open last night?
I did. I was not there. Cool. DeGrom was pitching. I didn't want to go up.
Are you watching a baseball?
No. When I was there for Emma, I went up to the top of the stadium, and with binoculars, I could watch some Mets while I watched her go down in flames. You can't do that with Serena.
I'm conflicted with Serena, Tom. I want her to do well. I want her to win. At the same time, the tickets are so expensive that if she drops out, then maybe they get cheaper. Very selfish, I know.
I mean, come on, they're outrageous, John.
She was brilliant yesterday. It's good to see her on form like that. But yes, Tom, they are outrageous. Absolutely outrageous. Futures lower on the S&P by a third. Things improve on the Nasdaq, down just 0.5%. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The largest U.S. airlines are now making more explicit pledges on how they'll treat passengers when they cancel or significantly delay flights. That comes after pressure from the U.S. government. The Department of Transportation has unveiled a website publicizing airlines' plans. The carriers are promising meals and hotel rooms in some cases for disruptions. In Jackson, Mississippi, a water crisis is making life miserable. Many of the city's 150,000 residents have been waiting in line for water to drink, bathe, cook, and flush toilets. The city's water system partially failed this week following a flood. Local authorities blame decades of deferred maintenance. President Biden says he wants to provide federal support. And in China, the city of Chengdu is locking down its 21 million residents. It's a huge move in the vast western region of the country that had so far been largely untouched by the coronavirus. The lockdown could affect electronics and automakers' supply chains. And a new report says that UK households are set for the biggest squeeze in living standards in a century. The Resolution Foundation warned of a 10% fall in real disposable incomes over 2 years unless there's a support package of tens of billions of pounds. Soaring energy bills have driven inflation well into the double digits. And in tennis, Serena Williams has extended her stay at the US Open again. The 23-time Grand Slam winner upset number 2 seed Anna Kontaveit 7-6, 2-6, 6-2 in a second-round match. Williams has hinted the Open may be her last tournament. In an interview after last night's match, Williams said, "There's still a little left in me." Global News, 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity.
We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully. And, the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
To me, the most costly mistake we will make is if we get fooled thinking, oh, we've got inflation licked. Now let's go cut interest rates because the economy is showing signs of weakening. So the way to deal with the lags, for me, is just to get somewhere and sit there until we're really convinced that we've got inflation linked.
Just an absolutely brilliant conversation with the Minneapolis Fed President Neil Kashkari on the Bloomberg Odd Lots podcast with our friends Joe Weisenthal and Tracy Alloway. Tom, it's one of those conversations where you're surprised that people are surprised by what someone's got to say. Happy with the reaction to Jackson Hole and not excited by the market reaction to the last Fed meeting.
It's a rare and beautiful thing, John. She's here for what? John, is this like a 2-hour interview we're doing?
I think this is 2 hours.
we could do it now.
Pushed into like 10 minutes, Tom.
Here's what you need to know. In 1961, a young boy named Mick Jagger went to the London School of Economics and went down in flames in mathematics. Tracy Alloway followed on from Mick Jagger and actually got through the rigorous math course to get your way along at LSE and went on to a sterling journalism career, including working with Mr. Weisenthal on Odd Lots, and she joins us here on the aerospace engineer from Minneapolis. Does Kashkari know what he's talking about?
Well, the interesting thing about Kashkari is that he's transformed from the Fed's biggest dove into the biggest hawk. And he says it's because he's been watching the data. Data didn't come in quite the way he thought it would. So like Keynes, he changed his mind, right? So that's the interesting thing about him at the moment.
I look at this, Tracy, and what's so important here is what do the monetary pros think? It was Clarida, and now it's maybe John Williams and a few others. What do they think of presidents shooting from the hip?
That's quite a question. What I will say, Jonathan kind of alluded to this about the interview that we had with Kashkari, where he was talking about how he welcomed that stock reaction, stocks actually going down following Jackson Hole. I cannot believe that markets were so surprised. You have had a Fed and you've had central bankers on the Fed talking about how they want financial conditions to tighten for months and months and months. And a component of financial conditions, of course, it's stocks.
Financial conditions. They need stocks lower. They need spreads wider. Tracy, what was the biggest piece of pushback you had against that? Because I was watching all the commentary over Twitter, the people who were surprised, and you and I who were surprised about them being surprised. What was the biggest piece of pushback that you saw from this interview?
There were a lot of people talking about how the Fed said the quiet part out loud, but these are the same people who would make jokes about how the Fed only wants to push up asset prices for the past 5 or 10 years, right? If the Fed only wants to push up asset prices, then they can have situations where they also want to push them down. Now is arguably one of those times. The Fed is explicitly telling you that it needs financial conditions to tighten in order to get a grip on inflation. The components of financial conditions have got things like mortgage spreads, bonds, and of course, stocks. So I'm not entirely sure why people were so surprised.
Hi, Tracy. Yeah, it was a really fascinating conversation that you had with him. I mean, if you want tighter financial conditions, you mentioned the other ways you get tighter financial conditions. Do we have a sense of which of the elements the Fed would prefer? I mean, we've got Kashkari saying stocks doesn't mind if they go down, but that's not quite the same thing as saying, you know, you really want them to drop.
Yeah, well, I think the big question in markets right now is why, even with all this Fed jawboning, why financial conditions haven't tightened more? Why are investors, I guess, dragging their feet when it comes to this issue? Does the Fed have a preference on exactly what moves the most? I think it doesn't want to see anything break in the financial market. It doesn't necessarily want to cut off capital inflows. It doesn't want to see a seize up in the credit market, which is something that we almost saw over the summer. But that said, it still wants something to happen. And the longer this sort of tension, the standoff between investors and the Fed goes on, the more likely we are to see a big move from the central bank that actually gets us there.
And that was really interesting in the context of what we've saw from UBS and others around credit markets just in the last 24 hours, saying credit markets are simply not pricing in enough a chance of a recession. We saw this from UBS. They said credit markets, by their analysis, are just giving it a 25% chance when actually they think it should be pricing in for a much higher chance that we get a recession in the US. Maybe this is the mismatch that you're talking about.
Yeah, this is kind of the amazing thing about the credit market at the moment. So you look at something like high yield spreads, so risk premiums on junk rated bonds. These are the things that are supposed to show concerns about a looming recession first. And we are far, far from those levels. I think it's something like 800 basis points on the high yield index. We're at like 450 right now. And then you have other people who are saying, well, don't look at junk bonds because the junk bond market has changed so much over the years. You know, it's mostly BB rated debt now. It's far from what it used to be. Look at something like leveraged loans. These are the floating rate loans that junk rated companies took out en masse for the past 5 years. They're supposedly very risky, or there are some people in the market that think they're very risky. And so those are where the first signs of stress could show up. But even if you look at the S&P LSTA leveraged loan index, we're at something like 95 on the cash level now.
Right.
85 is generally considered distressed.
Tracy, when you were at the Convent of the Sacred Heart in Tokyo a million years ago, you used to sneak into the Imperial Bar at the Imperial Hotel. The Frank
How
Lloyd
did
Wright
you
bar.
know that?
I knew that. You know, rumor has it. What does Japan do? As JP Morgan says, there could be a 140, 145 yen. Everybody's standing around in the West going, no big deal. I don't buy it.
Well, this is the other big question that I have about the Fed right now, and I actually asked Kashkari about this. What happens to the rest of the world when you are raising rates at the fastest pace in decades? We've already seen the dollar appreciate considerably. We haven't necessarily seen U.S. financial conditions move as much as we might expect, but we know that financial conditions elsewhere in the world are tightening. That seems like a problem for me when you're talking about economies, you know, Europe, emerging markets, to some extent Japan, that are now experiencing an energy crisis and everything is priced in dollars. The Fed is heaping more pain on the rest of the world. The U.S. economy is relatively resilient right now, but at some point you're going to get that boomerang effect. That's what Kashkari called it, where it comes back and it impacts the U.S. economy.
Interesting. Tracy, it's been too long. Is the podcast out right now?
It's out right now.
Fantastic.
Check out Odd Lots. I was
Here's
talking with
the promo. Gotta have it. Come on,
Squeeze it in.
come on.
That's the thing,
I was
Tom.
talking with Tom, and you know, he was actually our first guest when we launched the podcast 5 or 6
The
years
show
ago.
went up from there, John.
Downhill from there, or uphill from there.
Up
rather.
there.
Uphill.
I would say uphill, yes.
Tracy Alloway, Joe Weisenthal of Odd Lots.
You guys could
Look
do
for that
Pharaoh, you know.
podcast.
You
Just
could do
brilliant.
a whole football.
And that is really downhill, Tom. I think they want some expertise on markets, not on football of the weekend.
We could do joint things, you know. We could all four of us
We
travel
could do a
to
combination.
London and, you know.
We could do a joint tour, a podcast
John,
tour.
I just figured out with
conference.
Tracy's Asia experience, Party Congress China. Bramo,
You're trying to recruit people to that, aren't you?
Joe, Tracy.
If you can guarantee me that I don't have to do a hotel quarantine, Tom, I'll consider.
The 5 of us on a Peace Hotel looking over the Boon, the 5 of us, Wiesenthal would have to wear a suit and tie.
I don't know if Joe's going for the suit and tie these days.
He isn't. No, he's thrown them all out.
Much more relaxed kind of look now. Much more relaxed kind of look. He's got longer hair now too, TK.
I know. It's like,
they need to update the photo. Check out Odd Lots. Truly just absolutely brilliant from Tracy.
And it's done
Joe.
really well.
It's done fantastically well. Just a deep dive into some of the major issues at the moment. And the reaction to that conversation with Neil Kashkari, Tom, everybody picking up on it. Savita Subramaniam at Bank of America had this to say. Jackson Hole raises the risk for equities this fall. They still underprice the policy risk. The Fed finding inflation through financial conditions means that risk asset rallies both force and allow them to hike more aggressively. This we know, Tom, and it's becoming obvious for a lot of people in stocks right now.
It's in play, and it'll be in play here in 35 minutes, John's claims, and then on to the jobs report tomorrow.
Claims just around the corner. That's in the next hour. Futures lower by 1/3% on the S&P 500. On the NASDAQ, down by 0.6%. Live from New York City. Good morning. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Baseline inflation story plays out, and if you get some weaker wages, then I think we're in pretty good shape to have an expansion.
The key here is, does the consumer hold in September?
I think there are huge disparities still out there.
We're not really seeing the growth impact yet.
I wouldn't be surprised if equity markets go down a bit further from here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A most important Thursday. Forget about the dog days of August. The markets are on the move, and in this hour, they will move further. We've got data, we've got productivity data, and John, unsaid at 10 a.m., the first look at August.
Yeah, survey on manufacturing. That's going to be important, Tom, from the ISM. Looking forward to that. Before we get there, jobless claims in about 30 minutes. Then on to payrolls Friday, TK 298,000 on payrolls. It guessed a little bit early this morning. Do you remember that conversation, Tom? I said, is good news bad news? Is bad news good news?
Don't get me going.
He said, bad news is just bad news, John. It's not good for the equity market right now.
Well, we see it now with the data, and of course the data in Europe is grim. Anna Edwards in for Bramo this morning, and thrilled she's with us, particularly with her view on the linkage of the political debate in the United Kingdom into the grim data. John, let me start with you. You go to Anna. John, sterling says all.
A whole lot weaker, Tom, even with a big backup in yields. This morning, it's a break of 116, a clean break. 115.52 is the low. And Anna, right now, we're just above those lows at 115.70. Walk us all through the challenge that the UK faces and the whole of Europe faces too.
Yeah, I mean, in the UK case specifically, a little leaderless at the moment, waiting to find out who becomes new prime minister. We get that during your holiday on Monday. So that clears the political vacuum, but big questions over fiscal policy then follow because, of course, of the cost of living crisis, the cost of energy. We all know that conversation, and twin deficits in the UK put sterling front and center.
John, frame the inflation number over there. We're looking at 8-9% here. Am I right that Goldman Sachs published a 22% statistic earlier this week?
Possibly, Tom, could be the peak. After Citi said it might be something like 18, and after the Bank of England said it could be, well, something in the region of 13 percentage points, Tom. It's going to get worse, not better, in the view of so many people, and that's the difference between the UK, Europe, and what's happening here in the United States. In the minds of many in the US, we've already seen the peak inflation story. In the minds of many in Europe and the UK, for that matter, Tom, the peak inflation story is still in our future, not in our past.
John, let's go into the data here, and I want to take the two-year yield in Germany, legging out to new higher yield, and fold it, John, into a data check starting with foreign exchange. All of a sudden, dollar-yen nears 140.
Inflation up, yields up, rates are going to be a lot higher. We're looking for a 75 basis point move from the ECB next Thursday, yet still, you can't get that euro strength. Just sitting in and around parity on euro-dollar, negative 0.5%. That's a weaker euro in the mix again today. And Tom, that's the problem for this ECB. A higher interest rates, bullish or bearish, for this currency. What does it mean for this currency, Tom? Weaker or stronger in the face of higher interest rates, when the big issue right now is what happens with the price of gas, electricity, and how deep, not if we get a recession in Europe, but how deep. It's about how deep it will be, Tom.
There have been Augusts where we have recalibrated. And this August, this strange August, and yes, it was a strange Jackson Hole, we in spades recalibrate into the fourth quarter of 2022. Marvin Loeb provides leadership at State Street Global Markets. He is Senior Global Macro Strategist. I'm going to say, Marvin, you need to rip up the script on September 1. What's the new script look like?
I mean, the new script, you know what? I actually don't think the new script is that different than the old script. I kind of think back to what we were talking about before the June FOMC, which, for whatever reason, prompted the risk rally. We had yields somewhere around here, if not higher, and we were expecting a transitional data story that wasn't going to be clear until we got into the fall. We're back there at this point. So it's really thinking back to what really scared us in June and kind of realizing that certain economies are worse off whereas the U.S. is still kind of moving towards the story that we really have spent a lot of time on since the beginning of summer.
Marvin, we don't need things to be great or good. We just need them to be better than expected. Do you think they can be? And what do you need to see to get bullish this market?
You know what? I think we do need to get a sense of the inflation story and how it evolved, because that ultimately tells us when the Fed is going to get comfortable slowing down. You know, they've been saying that the data is volatile, inflation is especially volatile, and they don't really have a handle on it. They're trying to put numbers on it. But until we get a better sense of how that plays out over the course of the next couple of months, which, you know, for the most part, the market's expecting fairly aggressive improvements on the inflation front. If that proves correct, I think that you could start. I think you could start putting toes in the water.
So, Marvin, we're all trying to work out what's the price we've got to pay to get inflation lower. Do you see that reflected in the price of high yield right now in earnings expectations?
Yeah, no,
how low is that bar?
I think credit markets, in particular high yield market, has somehow been able to avoid dealing with that situation. I don't think it's priced in. You know, from a spread perspective, we're 200, 300, 400 basis points away from what you would expect in a recession. And, you know, we've been saying that the Fed ultimately, through its action, at a minimum, is going to cause a mild recession. And the longer this goes, the harder that recession gets.
Marvin, good to see you from London. What is it that wakes up the credit markets to what you're suggesting there then, Marvin? What are the data points that mean that the credit markets see those spreads widen?
Yeah, I mean, certainly there's been a repricing of credit the way we've had a repricing of a lot of the other risk assets over the last couple of weeks. So that it is starting to wake up. I think it's defaults. You know, ultimately, defaults have not increased as much because financial conditions, for the most part, still remain either, you know, average, if you will, over long-term perspective, but certainly quite loose given how much tightening we've put in the system. Once we start getting defaults because those financial conditions get tighter, then really the shock has gone across the bow at that point.
Marvin, we spent a lot of time today talking about the Fed, rightly, and a lot of time in recent weeks talking about the Fed and its driving markets and sentiment. Today we get a wake-up call, though, from China, where we see another city lockdown, just, in inverted commas, 21 million people sent into lockdown in an area of the country that's not seen much COVID. A stark reminder of one of the big risks that still hangs over here. How much of a threat is that?
I mean, I think it's absolutely significant. You know, obviously the importance of China in the global economy, you know, can't be overstated. You know, in a lot of ways, they are pursuing a philosophical approach that will need to reverse. There's no way that they're going to avoid that, and they're going to be doing that at a point when the world is slowing down. So you have risks from that perspective. But certainly, the longer they go on with this, the more challenging it is. And there are clear correlations between China and the emerging markets. That's pretty well established. But even from a global perspective, when the rest of the world is slowing down, it really does highlight the challenges we have going into the next couple of months, quarters even.
Marvin, what do you make of the current consensus that for the US economy, that if we get a recession, it will be short, it will be shallow? I keep asking that question, Marvin. I just want to try and better understand the risks around that view, given that the consensus has been wrong so many times over the last 2 years.
Yeah.
And this cycle is moving so quickly.
Yeah, absolutely. You know what? It comes down to the jobs market. So, you know, every first Friday of the month is the day that we certainly get all energized in terms of that number. It is incredibly important because a jobs market that's creating, even if we slow down to 250,000, that's a good number before the pandemic. That creates wealth, and I think that ultimately has kept some of the expectations around a recession more mild. What we heard from Jackson Hole is that there might be pain, or there likely will be pain at the household and business level. You know, I think that directly speaks to the jobs market. And unless we get a lot of people coming back into the jobs market, you're going to need to see very low growth and/or negative numbers to kind of get the Fed where it wants to be.
Marvin Lowe of State Street Global Markets out of Boston. Marvin, fantastic to catch up. Looking ahead to payrolls tomorrow. We haven't talked about it yet this morning, and you might have missed it late last night, but we heard from 3M, another company planning to eliminate jobs as part of a broader cost-cutting drive. Tom, you talked about how corporate America would adjust. You talked about how cost cuts would come Here they are from 3M, and this is the quote that they put out in the statement from the company. 3M is taking decisive actions to position the company for continued growth while also adjusting to the challenging macroeconomic environment. And Tom, that means job cuts.
John, I'm biased on this. My mother was a child of Minneapolis and Chicago long ago and far away. This is not the Minnesota mining and manufacturing of my childhood. It has been a challenge company with a 6.1% total return over the last grinding 10 years. They started cutting jobs 3, 4, 5 years ago from like a 96, 97,000 level. And it's just a continuation with an excuse now of all the turmoil that's out there.
As we prioritize our investments and resources, Tom, we will be adjusting on an ongoing basis the roles and responsibilities needed for future growth. And that future growth picture at the moment, Tom, looks a little bit softer.
It's just been a real industrial exercise. But John, to that point, we spend far too much time, and Bloomberg Surveillance is guilty of this. We love to talk to Dan Ives and others about Apple, Mark Gurman, and that Apple, throw in one other stock, John, Snap or whatever I can. You know what? This is about industrial America and service sector America, and they're being buffeted with this slowdown.
I wonder when we start to see that in the actual data, Tom, in payrolls.
It lags. It lags. It's a good
lot
question.
of companies make these moves.
question.
And Tom, I'd go further. I'd say the state of the labour market, the leverage that the employee had versus the employer last year has changed. That's for sure. So when you hear the banks, the likes of Goldman, the likes of Morgan Stanley saying, let's get back to the office.
What do you think?
Jeffries this morning, Tom, saying they need everyone back in the office on a consistent basis. This is what I think. I think relatively speaking, and I stress relatively speaking to last year, Tom, I think you've got a little bit less leverage this time around to say, you know what, no,
I agree.
I'm staying home.
I agree.
Do whatever you want. I'm
that
staying
statement.
home.
I agree. I don't know if Ann agrees. We'll talk to Ann about that in a bit here. But yeah, you know, I think it's, John, it's real. It's a real debate. I'm thinking, should I go from 3 days a week?
To what? 4?
4, 5?
You know you're meant to be doing 5 right now, right?
I thought I was doing 6.
Well, I'm doing about 3.5 at the moment. Tom Keane, Anna Redwoods, Jonathan Ferro. Bramo's doing 2. He's doing 2 days a week all summer.
We're gonna do sleep from office.
Lisa's back next Tuesday from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former President Trump has accused the Justice Department of criminalizing his possession of personal documents. He made the allegation in a court filing, seeking to bolster his case for a neutral third party to review documents seized by the FBI at his Florida home. The agents were investigating the presence of hundreds of highly classified White House records. In Alaska, Democrat Mary Peltola has defeated former Governor Sarah Palin in a special election for the state's only seat in the House of Representatives. That widens the Democrats' narrow majority, and it sets up a rematch with Palin in November for a full term. Peltola's support for abortion rights was seen as one of the deciding factors. In the UK, Liz Truss made a couple of eye-catching promises in her final pitch to become the next Prime Minister. Truss, who's favoured over Rishi Sunak in the Conservative Party leadership race, ruled out introducing any new taxes or energy rationing this winter. The next Prime Minister will be announced Monday. And problems for Microsoft's planned $69 billion purchase of Activision Blizzard. The deal will be sent for an in-depth review unless the company offers remedies to address the UK's watchdog's competition concerns. Regulators are concerned the combination will lead to fewer choices in the gaming sector. Microsoft says it's ready to work with them on their objections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. The UK Conservative Party decides who will succeed Boris Johnson as Prime Minister. As Rishi Sunak and Liz Truss go head-to-head, keep it tuned to Bloomberg for the latest news and up-to-the-minute results. Bloomberg, your global business authority.
China, I would say that's the number one concern in the market. Our expectation has been that China will be recovering. Now, that's not quite happening. Outside of China, demand numbers are still very strong.
Amrita Sen, with one word, China, the Director of Research at Energy Aspects, says China locks down 20.9 million residents in Chengdu. Just another headwind to the global economy for us all to consider. Live from New York City, good morning with Tom Keene and Anna Edwards this morning. I'm Jonathan Ferro. Bramo back after the long weekend. Equities lower by 0.5% on the S&P 500. On the Nasdaq 100, down 84 points. We're down 0.7%, just about off the lows. Yields pushing higher, back through 320 on a 10-year, 321.92. Let's call it 322 on a 10-year, up 2 or 3 basis points. TK, did you see the latest news in California yesterday?
Oh, yeah.
They've got to take these measures to conserve energy. They're telling everyone to get away from gas vehicles, get to electric. And ultimately, you've got to do that by 2035. And then yesterday, Tom, telling residents at one point not to charge their electric vehicles because it's stressing the grid too much.
So what we're going to do is stop. We're not going to talk to Francisco Blanch, head of global commodities and derivative research, or the price of Brent or this, that, or the other. We're going to talk about the greater energy moment that we're in. It is a crisis in Germany. It is a crisis in Anna Edwards' United Kingdom. And it goes to, as John mentioned, the grid. Francisco Blanch, I've seen endless studies. Davos, you could fill up the promenade with all the fancy studies about what to do. Why can't we fix this energy crisis? Why can't we fix the global grid of electricity and hydrocarbons?
Well, Tom, you've
kind of burning a lot of issues into a single question, but I think the best answer that I can give you is the uncertainty that we have created in terms of what the future demand for energy looks like. If you start with the International Energy Agency's scenarios for 2050 for decarbonization, there's a huge gap between the business as usual scenario, the aggressive scenario, or the net zero scenario. And it's really hard to tell which way we're going to go into 2050, whether global coal demand is going to collapse, or maybe it's going to hold in a little bit, or maybe oil demand will collapse, or maybe it won't. And I think the same thing applies to electricity, right? So all of that's kind of really difficult, make it very difficult for companies to make a decision in terms of how to allocate their capital. And then, of course, we've had the Russia-Ukraine situation, which has made things a little worse.
Surveillance research, Francisco, is that you and Savita Subramanian are actually on speaking terms at Bank of America. She has provided stunning leadership in the quantitative aspects of ESG. When you have a cup of coffee with her, can you state that ESG is here to stay, or is it dead with the war in Ukraine?
Look, I mean, I think ESG is here to stay in most people's minds. I think that's true for investors, true for governments. Which I think ultimately means for a lot of the pieces of the energy sector you're talking about, like how you fix them. I think you're going to have to end up with a lot more government involvement. We've seen that already in Germany and in France with the takeover of Uniper and EDF. I think we'll see just a lot more participation of governments generally. Even when you look at oil and gas investments, OPEC this time around, particularly the Gulf Cooperation Council countries, have actually been leading investment relative to other parts of the world. So I think governments are just going to get a lot more involved in the energy space on a forward basis to essentially get us through the current mess.
Francisco, do you think climate change has become a convenient excuse for some of the challenges we face right now, when a lot of it is about investment, a lack thereof, a lack of planning? And I understand we've had a big shock this year, but I think that's a convenient excuse in the minds of many people, Francisco, that we've tried to transition too fast, too quickly, and move away from fossil fuels without a more resilient plan in place. Which one is it?
Look, I mean, I think the climate change data that we're getting every day really points to the urgency of doing something about the carbon emissions that we have on a daily basis. We are warming up the planet very quickly, and we've seen that in Pakistan more recently with pretty catastrophic outcomes. We've seen a complete drop in water reservoirs in the Alps as well, which is leading to lower water river levels across Europe. So I think climate change is real. We're seeing one of the biggest droughts. I think you guys put that out recently. In Europe, we have the biggest drought in 500 years. So you're having a lot of data points out there that really suggest that the climate change is happening very quickly, and that's further straining our energy system as it would. Now, I do think we wouldn't be in the current situation if we hadn't been losing as much Russian energy as we have over the course of the past 6 months, right?
Francisco, can I ask you about proposals in Europe to cap gas prices and what you think of that? I spoke to a guest earlier, and this goes to what you were saying there about relying on Russian energy. I spoke to a guest earlier who said she doesn't want to see a cap on gas prices. She thinks fiscal stimulus should just be given to those who are struggling to pay, because with a cap, you don't have quite such a strong price signal, and we need that to make the transitions and the investments that you talk about.
I think that's completely wrong. I mean, I think you need to put a bit of a cap on the price of gas, and you need to remember, the price of gas is setting the marginal price of electricity, right? So let's say that if the price of electricity is €1,000 a megawatt hour, you're not really incentivizing anything at that price point. And there is a clear market failure that I think should encourage governments to take action here. And again, it's pretty simple stuff. I mean, you're above €200 a megawatt hour. Most European industrials cannot operate, right? So when you're at €1,000 a megawatt hour, this is past beyond the point of demand destruction. And it's also past the point of supply increases of renewable energy in the future. You don't need €1,000 a megawatt hour to encourage wind or solar power. You need a much lower number. So I think governments are taking the right steps to try to cap the price of gas. And again, it's going to be a subsidy for sure. But I do think that the consequences of not tackling the current shortage of gas in Europe could be devastating to both consumers and industry over the course of the next 6 months. Remember, you're probably destroying about 5% of European gas and power demand every month with this kind of price levels that we're seeing here.
So these are just massive numbers, Francisco, that I don't think we've still fully internalized and recognized how bad this is going to be. Francisco Blanch there of Bank of America Global Research. Francisco, you're one of the best. We appreciate your time. In the FT yesterday, they put out a story, Tom, 15 times the level of previous years. That's the price of electricity in Germany. And they were talking about how German companies, manufacturers, some of them, Tom, just shutting down. Shutting down.
John, most of America's complacent on this, and this goes back, I think of the legend Dan Fuss at Luma Sales, where we borrow electricity under stress, like from Quebec. Texas is our only analog, John, really, to what's going on in Europe.
Can I just say thank you to Francisco, Tom, for bringing up Pakistan. What's happening there is just so sad. They're calling it a monsoon on steroids. It's been absolutely brutal. Live from New York City, jobless claims. Coming up next, Mike McKee in the seat is going to break it down. This is Bloomberg Surveillance.
is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
What is your base case
for Italy in terms of what happens politically and then what the economic fallout is.
Jobless claims out in a couple of seconds. Mike McKee's going to break that down for you. I'm happy to say he's in the seat, live from New York City this morning. Good morning with Tom Keene and Anna Edwards. I'm Jonathan Ferro. Bramo's going to be back with us on Tuesday, I'm told, after a long weekend. Anna will be back with you on Monday to guide you through the leadership contest, the outcome of that in the UK, who will be the next Prime Minister, all that good, exciting stuff. Jobless claims coming in the right direction, Mike McKee. Downside surprise, the right kind of downside surprise. Run us through it.
Well, you know, it depends on what you're trying to accomplish, John. Jobless claims fall to 232,000 in the last week of August, and that's kind of weird in the sense that the Fed is expecting jobless claims as part of unemployment to rise as they tighten financial conditions, and that's not happening. Continuing claims go up to 1,438,000 from 1,415,000. So a little bit of a change there, and that's important because of people who are getting unemployment for the first time. More of them are staying on it, not a significant amount, but that's something to keep an eye on. The other number out this morning is productivity and unit labor costs, first time for the second quarter, and it is still bad news. Non-farm productivity down 4.1% after falling 4.6% in the first quarter. That is not good news for the economy overall for obvious reasons. The Fed would like to see that go up. As productivity goes up, you can use fewer workers, and right now we're using more workers and producing less with it. Unit labor costs up 10.2%. That's a bit of a decline from the 10.8% we saw in the first quarter, so that's a little tiny bit of good news. Labor costs going down just a little bit, but overall, good news on the labor front in a way, and bad news on the productivity front.
You framed it correctly, Mike, and I'm with you, but I think we both refuse to call a downside surprise on jobless claims bad news.
Yeah.
It's good news for the labour market. It's just problematic for this Fed, who's looking to get inflation down. And, Mike, that's just evidence, perhaps, that this labour market's still tight.
It is still tight. I mean, you look at the JOLTS report we got earlier this week, you have over 11 million jobs still out there. People who are losing their jobs are able to find new ones. So it's an interesting situation, and we're wondering when the Fed is going to bite.
Mike, I'm going to make a joke about this, but it's not a joke. Dollar legs stronger here. That's a fact off of this. And I you know, John and I have been making jokes all this morning. I know you just got into the office, Mike, but the basic idea is there's a prisoner's dilemma. I'm not going to go into it now because of time, but to pick two of the four boxes, there's bad good news or good news and the other opportunities as well. Which is this for Jerome Powell?
Well, I would say it's probably bad good news, in the sense that it suggests that somewhere out there is their goal, and they're not there yet. And you can see why people maybe have taken the markets have moved too much for today, because tomorrow's going to be definitive. But what we can do is go from there and
what
see.
Are you
Anna.
What are you expecting, Mike, tomorrow? What are you looking for tomorrow? Given what we've seen here and how the markets are responding, where does that leave us for tomorrow?
Well, the change in non-farm payrolls has dropped down to 298,000 for the estimate. I mean, that's a 2,000 difference. I'm not sure it makes a whole lot of difference. So anything in that range would probably be considered good or average, even though it's much higher than we were seeing before the pandemic. But anything above that would certainly be a shock to economists. 528,000 last month was roughly double what they had expected. And if you get that again, then the market is going to obviously think that the Fed is going to have to tighten further, and that will have an effect on where they go from there.
Mike McKee, thank you, buddy, as always, breaking it down for us. TK, this is a really interesting economy right now. I find it absolutely fascinating. Just how strong is this economy? How much damage needs to be done to get inflation down, and how high do rates need to go to get this economy down just a little bit softer, Tom? Because the labour market doesn't seem to be responding to this yet. And I get that it's lagging. I get all of that, but Yields are higher, Tom, at the long end on a 10-year, 325.
Yeah, I want to focus on that before we get to our good guest. John, sterling breaks down to new weakness seconds ago to a 115.50 level. And I'm looking at the real yield. John, I mean, you're going to have to blow up your show on Friday. Your late taping as we dive into the 3-day weekend. 0.78% on the positive 10-year real yield is extraordinary. These are important events for the economy.
We breached 350 a little bit earlier, Tom. I know you noticed that one. Did you see the Luke Cower quote earlier this week? Can I share it, Tom?
What, on lobster chowder?
Yeah. Let me read it to you, though, because I think it's pertinent to the conversation we're having right now. Just got back from yoga. This is Luke's travels. Teacher kicked off the class Vitalicus. The same boiling water that kills the lobster softens the potato. And that naturally got me thinking about the Fed. The Fed thinks the economy is a lobster, but right now, Tom, it's a potato. Now, if you caught up with that, then congratulations. But Tom, I think that's a really important thing to think about when it comes to this economy. Just how resilient is it?
Luke Kawa is a value add
Over
for the
UBS.
Union Bank of Switzerland. Very good. Blarina Yurchi's with us right now. She's going, why am I doing this? She's with T. Rowe Price, and we welcome her this morning. Blarina, what does a dollar signify? If you're sitting with Chairman Powell at the Eccles building and you see new dollar strength in a summed condition, what does it signal to him?
Well, I think we should think about what does a stronger dollar do for the U.S. economy and take it from there. If you're a central bank that is struggling with very high inflation, some of it from goods that are imported externally, you might think a stronger dollar is going to help bring that inflation down at the margin. It might not be the main force driving easing in inflation pressures, but certainly the Fed could use any help from any front it can get at this point. A stronger dollar also is going to be challenging for the U.S. manufacturing and net trade in general. So it does soften the outlook for the economy as well. But then more broadly, if we were to take a signal from this strength in the dollar, it's telling us that on a relative basis, the outlook for the U.S. economy might be stronger than for its trading partners. And the Fed is on a path to tighten interest rates at a faster pace and to maintain them there for longer than some other major central banks may have signaled. And again, I think that's something that the Fed is intentionally trying to convince the markets of. So I would take it as a positive signal.
Do you see weakness in the labour market, Blarina, creeping in? We've seen yields jump up on this data and the dollar on the rise, suggesting maybe the market's thinking we get more hikes from the Fed, that they're not seeing the weakness in the labour market that they need to see. Are you seeing any weakness?
That's a great question, and we just saw the claims data earlier. What we've been hit time and again is with this surprising resilience in the labor market and surprisingly strong momentum. Right now, I'm not seeing a lot of weakness in the labor market that would make me feel like a rolling over is imminent. So when I look at the payroll report coming out tomorrow for August, I would expect a significant slowing in the pace of job growth versus July. But then when I see the July pace of employment growth, it seems really at odds with what's happening in the rest of the economy, where the tightening in financial conditions is clearly having an effect and slowing demand and growth momentum. So then looking at the labor market going forward, I think this strength in jobs growth is bound to decelerate. And so I have that path going forward. The unemployment rate, I don't expect it to increase significantly. And then looking at and unpacking some of the survey data, we got the ADP report yesterday. That's been signaling since about late spring that job growth has been slowing in the economy. Looking at CEO surveys, the number of CEOs who expect either a hiring freeze or a firing has increased in recent quarars.
Blarina, so with all of that, tell me, what is the unemployment rate that you would say?
That's okay, Blarina. We'll let you go. We'll wrap it up if you've got a technical problem. Our apologies for that. Blarina Ricci there of T. Rowe Price.
John, I got a technical
problem.
John, I got a technical problem. Can I go?
You've always got a technical problem.
Thank you. Okay.
You can leave whenever you like. Leave Anna and I alone and we'll work through the sterling move,
Do
Tom.
trust Sunak.
Dollar strength off the back of this, Anna. What a move we're seeing again. Sterling breaking down. What are we at now? 115.52?
115.52.
Basically at the lows of the session. And Anna, yields higher as well. I think we're looking at 326 on a 10-year.
The market reacted quite a lot, didn't it? The market reacted quite a lot to that data that we just saw, Mike McKee breaking down for us. And to your point earlier about whether good news is bad news and bad news is good news, well, this looked like good news that's bad.
Tom, I think at the end of the day, good news is bad news because good news apparently means this Fed's got to do more, and bad news is bad news because apparently this means
help me here.
This is the outcome the Fed desires.
John, if Afterthought completes her summer reading on time,
good news.
Is that good news is good news, or is that bad news is good news?
Good news is good news, but good news is bad news, Tom, because it means she's going to go to a good college, and you know the fees in America.
You know it's going to cost
$80,000 a year. You're going to get hammered.
Absolutely
hammered.
Exactly. It's good. Bad news.
Good bad news, Tom. Here's some good news.
I'm sorry. This game theory. Alarian would tell you this game theory's baloney.
I know he would. We've heard this a couple of times, Tom. I think we've both said it. Other people have too. Where is Janet Yellen? Here you go, Tom. Next Thursday in Detroit, the Secretary of the Treasury will deliver, quote, a major address to discuss the Biden administration's economic agenda. I think that's some very good news, Tom.
Yeah,
good news on that front is good news. In a moment like this, we need to hear from the Treasury Secretary, don't we? I think so.
Yeah, John, 2 standard deviations technically on sterling is a 1.1518. We're not there yet.
Looking at this move on a 10-year too, Tom. Breach of 325 briefly.
Yeah.
324.76. Coming up, looking forward to this, Dan Skelly of Morgan Stanley Wealth Management, Daryl Cronk of Wells Fargo, Katie Kaminsky of Alpha Simplex to run you into the opening bell on Bloomberg TV. You want to join us, Tom?
Yeah, I'd like to do that.
Right, yeah.
It'd be good news or bad news, I don't know which.
Anna, thank you. Then we're going to catch up with you tomorrow as well. Looking forward to it as we guide you towards Payrolls Friday from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. The largest U.S. airlines are now making more explicit pledges on how they'll treat passengers when they cancel or significantly delay flights. That comes after pressure from the U.S. government. The Department of Transportation has unveiled a website publicizing airlines' plans. The carriers are promising meals and hotel rooms in some cases for the disruptions. President Biden wants voters headed into midterm elections to think more about Donald Trump and less about the economy. The president has been portraying the Republican Party as still being under the spell of his predecessor and his false claims about the 2020 election. Last week, he referred to his opponents as semi-fascist. Tonight, President Biden will amplify that message in a speech in Philadelphia. In China, the city of Chengdu is locking down its 21 million residents. It's a huge move in the vast western region of the country that had so far been largely untouched by the coronavirus. The lockdown could affect electronics and automaker supply chains. And a new report that UK households are set for the biggest squeeze on living standards in a century. The Resolution Foundation warned of a 10% fall in real disposable incomes over 2 years, unless there's a support package of tens of billions of pounds. Soaring energy bills have driven inflation well into the double digits. Add Jefferies to the list of financial firms that want their employees back to the office. Jefferies is asking staffers to come back on a more consistent basis to work through an investment banking backlog. According to a memo, the firm has no issue when employees need to work from home from time to time, but it wants senior bankers to be coming in to motivate their junior counterparts. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The earnings risk is now upon us, right? We're cutting numbers, and we think the numbers are going to come down even further over the next 2 quarters. So the bottom line for us is the PE multiple is wrong again, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook.
Best performance of the summer, Michael Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley, really has the high ground on challenging stock markets. Has done a great job there. We'll see where he stands here at the end of the fourth quarter. It's going to be really, really interesting. Futures negative 21. Anna Edwards in London, in for Bramo. John's off trying to get ready for the 9 o'clock show. It's Tang free. Right now on a chart, Kriti Gupta. What do you have, Kriti?
Yeah, Tom, we talk a lot about currency depreciation, weakness in the Japanese yen, which of course is hitting a 24-year low, and also weakness that we saw in the Chinese yuan. The PBOC is now trying to push back. Instead, I'm looking at the Korean won, the key third player when you look at that trifecta. This is important when we talk about trade coming out of Asia Pacific, and specifically with this morning's story, Tom, on chips in particular. We know that the chip exports out of South Korea have actually dropped year over year. That is not good given the momentum that we are still seeing in the demand space. So my chart of the day actually looks at the dollar versus the Korean won, and we are seeing some pretty record weakness there, going back to levels we've seen in the global financial crisis, and Tom, before that, the Asian financial crisis. Not looking good for those who want to buy chips right now.
We rip up the script right now. As we talked to Anna Edwards earlier about Truss and Sunak, we're talking about the moment at hand. The moment in hand and away from the United States of America is emerging markets, and buried in the headlines of a busy end of August is Georgieva to the rescue. This is the IMF doing it differently this time. Damian Sassower, with arguably his most important interview ever with us, Chief Emerging Markets Credit Strategist. Boy, are they early, and boy, are they tactical, and boy, are they surgical.
So we have seen just today alone, $1.3 billion loan paid to Zambia, $1.2 billion to Pakistan. There's another $2.9 billion that's going to Sri Lanka. And we saw, of course, an 18-odd billion credit line offered to Chile to protect the currency around the constitutional referendum. So there's a lot of bear case to be made for emerging markets, but it's really tough to fight the IMF. It's like fighting the Fed in emerging market land. So, I'm not saying I'm bullish on emerging markets, but this is a step in the right direction.
When we see it, we're seeing an unraveling. Kriti Gupta talks about a powerhouse like Korea. Forget about that. I see Marcos Jr. takes it in the Philippines, and he's enjoying new Philippine weakness, and we can pick on 7 other nations as well. Does this have a 90s tinge to you?
Absolutely. No, look, this time, we've been waiting for the Asian central banks to finally, get the clue right and start hiking rates. So we have seen the Philippines, Indonesia finally raised rates, Thailand, you name it. But you're absolutely right to focus on the Philippine peso, weakest on record, Taiwan dollar, weakest in 2 years. You've got, the China yuan testing the 7 handle. The real, which is the strongest emerging market currency year to date, has failed to break through 5. It's now at 5.18. You've got the Mex peso back above 20.
Yeah,
let's go on and on. The rand is back above 17. It's currency weakness writ large. But again, the IMF seems to be getting the message here and stepping in, but not to the majors.
Damian, joining us from that emerging market, the United Kingdom, Anna Edwards.
You've just upset some people on Downing Street at the Treasury. Let me ask you, Damian, on that point, though, about weakness in currencies elsewhere and strengths to the dollar. You've mentioned what the IMF is doing to help out those individual emerging markets that are really struggling right now. But what about concerted, coordinated action on dollar strength? Are we talking about that seriously? Every now and again, that subject raises its head.
Well, Anna, we have to start talking about it. I'm surprised that, the ECB, I'm surprised the BOE haven't started talking about it already. It's coming. Look, there's one thing that it seems to be kind of a staple throughout, the better part of the last 3 years, and that you can't knock King Dollar off its pedestal. It has just been ruthless. And so look, 60-40 being dead, all that stuff that goes hand in hand. The one thing that's dead is non-dollar assets, equities and bonds. Forget about it. There's no place for it in your portfolio if you listen to some of the experts here. So throw Markowitz out the door, Anna. Diversification only works if you're in dollar assets and dollar currency. So it's a real tough job for portfolio managers, especially emerging market portfolio managers, to kind of allocate across this beta regime. I think what you're going to find are more people carrying in emerging markets, albeit on a currency hedge basis, to avoid that risk.
Yeah, one of your recent pieces of research, Damian, says passive fund flows signal renewed interest in EM debt. Where are you seeing that money go then?
Yeah, that was probably prior to this week, Anna. No, I'm kidding. No, we had seen, yes. For the better part of last month, all high beta assets sort of rallied, and emerging markets surprisingly so.
Right.
But now I think, we're on the other side of this. And, even though you see the likes of BlackRock, Proof, Fidelity kind of, scaling back on their bearish China calls, because, look, the whole pyramid is collapsing in China right now. That is it. You've seen.
But Damian, just because of time, I got to cut to the chase. It's the end of August.
Yeah.
This is not fun. I'm looking at the Bloomberg Global Aggregate Index price back to 2011 levels.
Yeah.
Why would anyone sane be in EM right now?
The market value of the Bloomberg Global Aggregate Bond Index is $59 trillion. It is down $2 trillion in the last 2 weeks, Tom. 2 weeks. It was coming back.
You've been great on this. Time and time again, people go get into EM, get into international, blah, blah, blah.
More than 50% of that index is non-dollar fixed income. Think about that, right? So, the dollar impact is basically impacting, the global investable fixed income market more so than anything.
Do you get a jump condition? Is this stochastic processes where you're going to see real price down? Ecuador, Thailand in the 90s,
spreads.
Mexico?
The only jump condition we're waiting for it. It hasn't happened yet. And if you look at U.S. financial conditions, they've come roaring all the way back, right?
Yes.
So we've been waiting, and I think we're going to continue to wait. It may not be next month, next year, 2 years is what the experts are saying for spread widening. You got to look for spreads to jump in order for you to really get financial conditions to tighten.
Damian Sassower, sports guy, Serena all the way?
Oh, yeah. Did you see, by the way, last night? What a match. And by the way, the crowd, Bill Clinton, Dr. Ruth was there. Tom, I'm a big Dr. Ruth fan. You had Dr. Ruth, Bill Clinton. You had Tiger Woods was in the crowd. She was awesome. I can't wait to see. She's playing, I think, with her sister, right? They have a doubles match this evening.
I think so.
Wow.
Damian Sassower. past hour. Thank you so much. Ann Edwards, did you survive today?
I survived today. I survived better than Emma at the tennis.
Well, yeah, well, that was, I was way up high. I had it, Damien. So with Emma, I had binoculars so I could watch Mets Dodgers at the same time over the rim. Yeah, it was great.
Strategic.
Okay. Anna, you're going to come back tomorrow?
I'll think about it.
Okay. Anna Edwards, tomorrow for Jobs Day in America. Please join us. Futures -24 on Bloomberg Radio and Bloomberg Television.
Welcome back to another special U.S. Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. The Serena Williams Farewell Tour continues at Flushing Meadows. The 23-time major champion came through a thrilling 3-set victory over world. Earlier, Coco Gauff also advanced with a straight-set victory over Elena Gabriela Russa. The American has now won 10 of her last 12 matches at the Slams. Up next for her, compatriot and former finalist Madison Keys. And don't forget, Tennis Channel Live at the U.S. Open has all the news you need from the Big Apple. It airs daily at 9 a.m. Eastern. I'm Johnny Ray Diaz.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
4 days of losses on the S&P 500. Will it become 5 as we kick off a brand new trading month? Live from New York City this morning. Good morning, good morning. Futures down 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Goodbye, August. Hello, September.
September.
We're buckling up.
It will be a September to remember.
You get the August CPI coming out in September.
The September Fed meeting on the 21st.
QT doubling in September.
This is going to be a big issue.
A factor for not only repositioning portfolios, more broadly speaking, but how to think about it.
2-year bond yield is up to a high that you haven't seen since late 2007.
We're going to see a lot of volatility.
Does the consumer hold in September?
As the Fed destroys demand, what will happen to consumer is yet to be seen.
Consumer sentiment has been absolutely abysmal the entire year, and spending has been fine.
There is some sense that some parts of the real economy might be responding to rates.
I think we need to buckle up for September.
I'm not going to blow up this show because Twitter has an edit button. We'll do that later. Joining us now, Katie Kaminsky of Alpha Simplex, Daryl Cronk of Wells Fargo. They don't care about that. Katie, I care about this. This market's down for a 5th session. Do you want to buy it yet?
Not yet. I have to be honest. This is what we've been predicting and thinking about since earlier this summer. We've been worried that the market was too optimistic and that the reality was going to set in. And that's exactly what we're seeing. That short bond trade continuing. You're still seeing also the strong dollar. And really sort of the only thing that's changed direction has been the commodity block, which is really starting to show some recession type and demand destruction like activity.
Daryl, you've said it. Peak inflation, peak hawkishness. We've got a new issue. It's about persistence. The persistence of all of these themes. Walk us through it.
Yeah, so I think it's more like wake me up when September ends, John. I mean, let's just get through this month. I mean, you've got a number of key things. Seasonality is bad in September. It's the worst month of the year for the Dow and the S&P historically. You've got a well-publicized quantitative tightening that's doubling this month, which we know about. Also, which kind of flies under the radar, you know, buybacks will wane on us here mid-month because as companies go into the blackout period for Q3 earnings, they're going to stop the buybacks. And also, we expect a heavy dose of earnings revisions in the month of September as companies start to really mark down those earnings, which they've been somewhat resistant to doing up to this point.
It sounds pretty brutal, doesn't it? Bank of America on the same page of Savita Subramaniam leading the team over there saying this. Jackson Hole raises risk for equities this fall as they still underprice policy risk. The Fed fighting inflation through financial conditions means risk asset rallies both force and allow them to hike more aggressively as the Fed put has given way to a short Fed call. Katie, everyone's on the same page with that. With that in mind, what does the data mean for the market? We've experienced good data this week, but that's bad news for the market. What is bad data? Bad news or good news?
So bad news has typically been good news recently, but I'm afraid to say that bad news is not necessarily going to be good news going forward, in the sense that it's clear that the Fed is going to hold their bearings and that we're going to have to see the fight against inflation. And I think this last week has really showed that the market finally has given way to that. And if you take a look at the curve, you can really see that inversion really accelerating recently as well. And that's something we're really focusing on. Will we see more inversion and thus more short signals in the bond complex going forward? I think so.
The bond issue, Daryl, we've got to discuss. Yields up, equities down, yields up and away over in Europe too. Can you tell me what you think is going on over there?
Well, the data coming out of Europe is just nothing short of abysmal, basically. I mean, you saw earlier this week that Germany PPI at 37% year over year. You know, the euro continues to fall, the pound sterling continues to fall. So Europe is just going to go through probably the deepest of the major developed markets recession, probably even deeper than the US, likely deeper than China, although China's data has not been terribly great lately. And so I think you got to watch rates closely here. I mean, the 2-year, the short side of the curve has never blinked, right? We keep pushing the 2-year higher. We're as high as we've been since September of 2007 on the 2-year. And I would just remind you, at that time in 2007, we were looking at earnings on a forward basis at 14 times, not 17, 18 times today. And you had a 3 in front of inflation back then, not an 8.
This is what I'm struggling with at the moment on the yield side of things. We've got the 2-year back to about 350, just short of that level right now. I think we've all got to wonder if we've taken out the June 14 highs on a 10-year yield, on a 2-year yield rather, do we belong somewhere near the June lows in the equity market? We caught it with Mike Wilson in the last couple of days on that. Take a listen to what the man from Morgan Stanley has to say.
June probably was the low for the average stock. But the index, we think, still has to take out those June lows. The equity market is being too optimistic about the earnings outlook. And usually the way that resolves itself is the multiple will start to come down as earnings get cut. And then somewhere in the middle of that earnings cut process, the market will bottom. And we think that's probably sometime between probably September and December.
Casey, would you go with that theme? Do you agree?
I would have to say that I agree, John, in the sense that what we tend to look at is cross-asset themes. And I hate to say it, equities tend to not necessarily be as easy to time, and then what we look at is more looking at the cross-asset themes. And those cross-asset themes have been really, really strong recently. They had abated, but we're starting to see those themes really suggest that there's more issues coming and that equities probably will follow.
Look at this long list of issues from Barclays, essentially saying there's no place to hide. Fears of tightening liquidity, driving a surge in cross-asset correlation. Katie's often talking about that. The tape is fragile with the fluid gas situation in Europe, mixed inflation data, weaker data in all regions, including China, and no central bank put strike in sight. Taylor Riggs has more. Hey, Taylor.
Wasn't a good August, John, as you've been talking about all morning. Take a look at sort of the cross-asset picture. Stocks, the S&P, yesterday we ran the headline off about 4% for the month. The NASDAQ 100 off more than 5% for the month alone. Commodities, we'll call that about flat for the month or so. And then you did get further dollar strength and a 2-year yield that rises 63 basis points for the month of August alone. And that is part of the problem, John. And as long as I've been alive, you have people calling for the death of 60-40. But the whole point is when you take a look at the terminal chart, you want the equities and the bonds to be non-correlated, negative correlation, because when one goes up, you want the other to go down. The problem with August is you saw both fall together and you got that positive correlation, which again brings up people saying that they don't really like that 60-40 portfolio. Maybe we'll save that debate for another day. I think the big debate that you're having on this program is how we're thinking about September and the bottoms that we saw in June. Do we start to test those again? You just heard from Morgan Stanley. Jeremy Grantham, huge legendary investor over at GMO, saying that he's looking for another big drop, that the super bubble, quote, hasn't really popped yet. You've Jeff Gundlach tweeting about further yield curve and the stability of that signal and what that means for a recession. So a lot of signals coming that maybe we haven't sort of hit that bottom yet.
Taylor, thank you. Brilliant, as always. Taylor Riggs there, just on some of the cross-asset correlations. Lou Wang of Bloomberg broke down August for us. Equities down, treasuries down, high-yield credit down, commodities down. You get the picture, don't you? Can I go over the month of August in foreign exchange and in the bond market in Europe? This is a snapshot of things over the last month, and I want to pay close attention to what's happened with yields and what has not happened with the currency. Yields over the last month on a 10-year in Germany up about 82 basis points, currency weaker. In the UK, the 10-year yield up by more than 100 basis points over the last 30 days, currency weaker. Sterling's just had its worst month going all the way back to late 2016. Katie, I want to come to you on this, and I want you to try and help me understand what's going on right here. Why are higher yields not supporting this currency? And are we starting to see an additional risk premium come into some of these bond markets because some of the extra funding these governments will need to offset the stress, the pain in the energy market?
This is a really good question. We've seen this theme very strong this summer. The dollar has emerged the strong winner against other currencies because of relative positioning and, of course, the relative positioning for the U.S. to deal with things like energy dependence and other issues. And so we're continuing to see this theme that even though we're seeing rising rates, the relative effect on the currency is not as strong. I think it's something that could revert should we see the ECB start to move and actually create more pressure, but so far it's really been a relative positioning story where the U.S. has come out ahead, despite the fact that everyone's fighting inflation at the same time.
Katie, where do you think it's going ultimately? I'm not talking about some kind of sovereign debt crisis in Europe. I don't want to get too extreme just yet, but I want to understand the base case from you. Where do you think it's going?
So in terms of currencies, I think the dollar has been so strong, there is some room for that to revert. I mean, if you look at it, it's at a 24-year high against the yen, and it's done really, really well. So I would just say that there is some room for that to back off a little bit, and it's really going to depend how European governments and central bankers can react to their inflation problem in relative sense to how we are handling it here in the U.S., where it seems to be somewhat firmer.
Kitchusa Sogchen, building on some of this, saying higher gilt yields aren't so helpful when people see them as the price the UK pays to suck in huge amounts of money. He goes on to say, the UK economy is in recession, the balance of payments is catastrophic, and more faster rate hikes won't do much to restore confidence. Daryl, whenever I talk about Europe, it's almost depressing. I said it earlier this morning, we don't need things to be great, we don't even need them to be good, we just need them to be better than expected. Daryl, how much worse can it get? Can things get any worse in Europe?
Unfortunately, I think they can get worse for Europe in the near term. I think the Germans are regretting right now that Merkel gave away a lot of their LNG production, right, and fell reliant on places like Russia. Again, you know, the UK is really struggling. I agree completely. It's in a recession. I think the challenge here going forward, John, is going to be how much political unrest. You've got a whole new cove of leaders across the Western European continent that weren't there when we put the euro together and the Eurozone together. I don't think it breaks apart ultimately, but I think it creates serious strain and stress in that zone, and the economics are going to keep driving it.
Weaker currencies over there this morning, that's for sure. Daryl Katie sticking with us. Futures down 0.7%. Let's get you some movers going into the open. Here's Abby.
Well, John, for $4.99 a month, you can now edit your tweets. Well, maybe not you, but some users out there can at least. Twitter is, of course, now trialing this edit function that's been debated for years. They have a premium subscriber. $4.99 a month will allow you to edit tweets. The stock's not doing all that much. In fact, it's down, so investors not thinking too much about that. Where we do have some real weakness, NVIDIA down 4.8%, fresh China lockdowns, 26% of the revenue comes from China, and of course, the company also warned on $400 million of revenue relative to 2 AI chips that the U.S. would restrict the exporting on fears around the military, the Chinese military using it, that they would have to be approved. So that stock is lower. Microsoft, big tech, lower in general as yields are higher. And we also have big energy lower, John. ExxonMobil down 1.4%. This as oil is back near $87 per barrel. Not a lot of good news. I don't know how you feel about that Twitter edit function. I'm more of a purist, but of course Elon's poll supported it. We'll see how this goes.
Can we expense it? The $4.99.
That's an interesting question. $4.99, yeah.
You asked management if we can expense that. Abby, thank you. Coming up, China locking down another major city.
These mobility restrictions are likely to have an impact on prolonging the economic weakness in China, and that will have repercussions in the region, but also globally.
Chengdu, 20.9 million residents locked down. That conversation up next.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
We're looking at a US economy which, in our view, is headed for a slowdown, Europe, which is in trouble, and then the third big block, obviously, China. These mobility restrictions are likely to have an impact on prolonging the economic weakness in China, and that will have repercussions in the region, but also globally.
Global headwinds piling up, another major city in China locking down, 21 million residents falling victim to the country's COVID-0 policy. This coming as NVIDIA warns of a sales slump amid new US restrictions. Team coverage starts right now. Bloomberg's Ender Curran in Hong Kong, Abigail Dillittle here in New York. Ender, I want to come straight to you, sir. 21 million people. What is going on here?
It's the biggest lockdown since Shanghai, John. It's the first time we've seen a lockdown on this scale, by the way, over in Western China too. It's a reasonably important industrial hub. It's known for auto production, electronics production, makes up about 2% of GDP. Also popular with tourists, by the way. It is a very popular panda sanctuary over there. And it speaks to the idea that China is just so determined it's not letting go yet of this COVID-0 strategy. We've had reports, plenty of footage on social media of food rushes now, people scrambling to get provisions before they get tied down for the next few days as it undergoes mass testing. Next door to Hong Kong, Shenzhen, also undergoing fairly strict restrictions. That's, of course, a key technology and manufacturing hub too. So clearly all of this is going to weigh on China's economy. It will weigh on the industrial side of things. And it does show that China has a long way to go before it starts navigating away from its aggressive COVID-0 approach.
And the team at Bloomberg Economics say it's 1.7% of GDP. What kind of numbers are you thinking about going into year end now, just in terms of GDP growth and, for that matter, into next year?
Well, people are kicking a ball around, say, the 3% area, Jonathan. That's where it seems to be heading. Their big investment houses are lowering their forecasts week by week. And you would have to say when we get news like this out of Chengdu today, they're only going to put more pressure on those forecasts. As for next year, I think it's anyone's guess. It's whether or not a big policy pivot comes. We've got the Congress coming up in mid-October. That will dictate a lot as to whether China does pivot on real estate or on COVID or on something else.
Fascinating trying to keep up with this. Abby, trying to keep up with NVIDIA in the last 12 hours, difficult too.
Indeed, and the stock is down sharply at the lows yesterday. In the aftermarket, it had been down as much as 7 or 8%. And this, of course, on the news, the company warning that they could be vulnerable to losing about $400 million of revenue as the U.S. is now requiring them to have 2 different AI chips basically approved before exporting them to China. So this is, not a huge amount of their revenue. It's a $30 billion revenue company, but it's not moving in the right direction. And then, of course, you have these lockdowns as well. 26% of their revenue comes from China. And John, if you recall, this is chip giant. They pre-announced back in early August. They pre-announced by about 10%. Then they reported last week or the week before. It was a messy quarter. So they've seen some of this coming. Now, if we put this into the context of the broader picture, this stock had been up more than 1,000% from the 2018 lows, but this year down almost 50%. So this company, investors are aware of these challenges. And again, this slice of revenue coming from having to have those 2 AI chips approved by the U.S. government before being exported to China, the fear that they might use it in their military operations. It's a tiny slice, but it just really points to the tensions also between these 2 governments.
Tensions in a big, big way. Abby, thank you. I'm going to do a little there. And of course, Ender Curran too. This report came out yesterday evening from the UN. I want to share some of it with you. That China committed, quote, serious human rights abuses. This UN report went on to say, as they looked at the detentions of Uyghurs and other Muslims in the Xinjiang region, that there was a broader campaign of rights violations that may, quote, constitute international crimes, in particular crimes against humanity. The assessment found, quote, patterns of torture or other forms of cruel, inhuman or degrading treatment or punishment. The Chinese have responded. This is a response from Beijing. I'll show you their response. They said these allegations were, quote, the lie of the century. The Chinese government, they went on to say, they called the report illegal, null and void. I mean, pretty depressing stuff coming out of China here. Daryl Cronk, Katie Kaminsky, I want to bring you back in. Daryl, with all of this in mind, the cross currents around trade, the slowdown because of COVID-0, the allegations of genocide, what does it mean for how you approach that region at the moment?
Yeah, I think you've got to be underweight China. I mean, China has thrown an immense amount of stimulus, as they always do when things slow down, equivalent to about 8% of their GDP already this year. More is absolutely coming. But what is just crazy weak over there is the real estate market, the housing market, whether it's sales, prices, credit growth, any of it. And I think what doesn't get enough attention, John, on China is everybody talks about the dollar versus the yuan and the strength the dollar's had. The yuan is strong against its major trading partners in the rest of Asia, which has really been abysmal for credit growth and exports there, right? And so exports are the lifeblood of China, and without that export growth is going to really struggle here.
Katie, how can we make a call on anything, on commodities, on foreign exchange, on equities, on global growth, without a deep understanding, a decent view of what's going to happen with the world's second largest economy? How can we do that?
Well, it's difficult, and I think what we're seeing right now, the biggest area I would look at today is take a look at nickel prices, take a look at copper. These are commodities that are directly linked to something that was an issue for supply, and now it's a demand story. So I'd say that this particular narrative is really across multiple different asset classes, like we've discussed. So looking at the currency, but more importantly, looking at raw materials and where they're leading in terms of what to expect going forward and how big of an impact this may have on the rest of us globally.
Katie, are you thinking about more onshoring? It's been a theme that I've heard said before in this program, heard you talk about for that matter too. Are you looking for more of the same?
Definitely the case right now. I mean, I think the biggest shift that we've seen is just a massive pivot in the commodity sector. So you saw earlier this year that inflation narrative being a long commodity signal, and now we're really seeing that demand destruction, that negative signals in the commodity sector that's very consistent with cycles in inflation and cycles in prices that are very destabilizing for companies and for business.
Just to round things up, Darryl, when you see a lockdown of a city that large, are you thinking more of growth issues or inflation problems? Which side of it are you thinking more about, the demand side or the supply side?
Absolutely the growth side. You've got the combination of basically Shanghai, Shenzhen, and now Chengdu locked down, which are the largest cities in China for COVID reasons. You already had a struggling growth situation. What'll be interesting here is what was noted earlier is the October 16th party getting together, basically, and as President Xi wants to go for a third term, he doesn't want a growth scare and he doesn't want an inflation scare, to your point. But the growth scare is real. I think at this point they've been able, because of declining demand, to keep inflation under control. And we would anticipate that's probably going to be the case for a while here.
Darryl Cronk, thank you. Alongside Katie Kaminsky, coming up on this program, the morning calls, then later, Morgan Stanley's Dan Skelly, expecting stocks to keep moving lower. Are we having a little look again at the June lows? Will we? Before year end. That conversation coming up at the opening bell. From New York, this is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Minutes away from the opening bell in New York City this morning. Good morning. 4 days of losses coming into today, down about 5.8% on the S&P. Kicking off September with futures lower 0.6%. That's the price action. Here are your morning calls. First up, JP Morgan upgrading Baidu to overweight, $200 price target, seeing upside driven by positive earnings revisions. Next up, Raymond James downgrading Bed Bath & Beyond to underperform, highlighting the company's sizable cash burn and abysmal business trends. The stock's down by more than 4%. That's a brutal note. Finally, Loop Capital downgrading Hewlett-Packard to hold, $29 price target, expecting a challenging macro environment to continue weighing on demand. Their stock is down by 1.4%. Coming up, Morgan Stanley's Dan Skelly still looking for a bottom in this equity market. That conversation up next.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From New York City,
in London, in Sydney,
in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
23 seconds away from the opening bell in New York City this morning. Good morning to you all. We've gone over the losses over the previous 4 days. Down over the last 4 days by almost 6 full percentage points on the S&P. We're softer again. We're down 6 or 7 tenths of 1% on the Nasdaq 100. We're down 9 tenths of 1% on the Russell or small caps. Down almost 1 full percentage point. That's the equity market action. That's your opening bell. Switch at the board and get to the bond market. Yields higher. Jobless claims better. Claims a downside surprise. That's what you want to see. Maybe not what the Fed wants to see, and that's the problem right now. In the equity market, yields up 6 basis points in the bond market on a 10-year, 325 on 10s. On 2s, had a little look at 350 a little bit earlier on. Look at the dollar strength out there. Euro dollar, negative 7 tenths of 1%, 99.85, even with a long, long list of banks teeing up a 75 basis point rate hike next week on September 8th. Crude's lower by about 2 full percentage points, $87.72. 30 seconds in, that's the cross-asset price action. We're down about 6 tenths of 1% at the opening bell on the S&P. Let's get you some movers. We can do that with Katie. Hey, Katie.
Hey, John. Well, it's already shaping up to be a bad day for the chip sector after the U.S. limited sales to Russia and China, of course, on security fears. NVIDIA did say that could cost the company $400 million in sales in the second quarter. NVIDIA got limited licenses for AI chip exports to China, but still a bad day for the stock, already down 5%, bringing down the likes of Broadcom as well to about 2%. Keep an eye on Broadcom today because they report after the bell. Moving on, you had Campbell Soup reporting earnings this morning. Sales were actually 6% higher on higher prices. That turned out to be a wash, though, because expenses jumped 12%. That dragged down margins, dragging down the stock early this morning as well. And meanwhile, the job cuts continue. 3M coming out, cutting jobs to save cash amid high potential legal costs. This news, of course, hitting a day after we heard from Bed Bath & Beyond and Snap on their job cuts. But prices little changed right now, John.
Let's just clear this up. NVIDIA, not NVIDIA. NVIDIA?
NVIDIA? I don't know. That
NVIDIA?
might be the New Jersey accent
I don't know,
a little bit.
but I don't know. I'm trying to clean it up.
Sounds better when you say it. Sounds better.
I don't know if that's true, Katie. Not sure if anyone agrees with that. Katie, thank you. NVIDIA? Anyway, let's go with that. Just say it really quickly. Down about 5 or 6%. Abby's got more. Abby, which one is it?
I've always gone with NVIDIA, so
there we go.
I'm not sure if that's right.
Done.
But
you and Katie win.
Okay, well, maybe, but I don't know. I agree with Katie. It might sound better when you say it. But in any case, any way you say it, the stock is down sharply, down about 5.7%. And this is just one slice of the weakness that we're seeing for chips right now. Now, of course, NVIDIA is down for 2 reasons today. A double whammy. Chengdu, as you've been talking about, has been shut down. That's 1.7% of the Chinese economy. And they received 26% of their revenue from China. So you have demand concerns. That's been a story for NVIDIA for some time now. They pre-announced in early August. They also put up a messy quarter. But then on top of it, what Katie was talking about in terms of the U.S. Requiring approval for some of their AI chips to be shipped to China on security fears around the military, that's $400 million worth of revenue potentially. Not a huge slice of the pie, but it's more the direction, the tension. And you have these chip stocks under so much pressure. Over the last 10 days, the stock's losing 10% of its value on the year, down much more sharply. And why this is so important, John, chips, of course, the stocks, it's a leading indicator. Chips are used in everything that we use today. So if you see a big slide here, it tends to lead the broader indexes. So really not a good sign potentially for the markets and the economy overall. And if we see more of a slide, because of course it's not just NVIDIA, Seagate, Flash Memory, they cut their third quarter by $400 million. Micron, that's NAND and DRAM, they see their third quarter coming in at the low end. And then Citi seeing, this is pretty bearish, 25% more downside for the stocks. And it's interesting because, as you know, John, yesterday, Jeremy Grantham said that that volatility that we've seen this year, it's just an appetizer to what could come. That matches that potential 25% slide on the stocks. It could just be brutal from an economic standpoint.
There's so much bearish stuff out there. I need a nice Marko Kolanovic note over at JP Morgan just to get my teeth into and talk about the bullish side of things for 5 minutes or so. Abby, thank you. Another slide here. 5 days of it now. 5 days of losses on the S&P 500, longest losing streak going back to, I think, July 14th. Over the last 5 days, down about 6.5% on the S&P, and now about halfway back to the June lows. From the highs of August, back to the June lows. Taylor Riggs, we're getting closer.
And I'm afraid that I'm not here to provide any of that positive sort of information, John, that you wanted, because take a look at this terminal chart, and we showed this yesterday. Sort of the big run-up that we had off the lows of June, you were up 20, 25%, and then, of course, all of that cut in half. Take a look at the last 2 weeks. You're now only up maybe 5, 6, 7% or so off those big bottoms that we had. It's interesting when you think about the last 2 weeks. Some of this is a micro story. We still did continue to get a lot of some of the quarterly results. Dollar Tree, Salesforce, Match, NVIDIA, as Abigail was talking about. So some of that was sort of this micro sort of individual story. Otherwise, it was some of those broad micro headwinds that we've continued to talk about. But those, of course, have been the stocks that have really been the hardest hit off of the peak that we had just about a few weeks ago. But don't ignore big tech, because that's also where a lot of the declines have been coming down to. Big tech is down about $1 trillion when you think about market cap, and it is the biggest of the big. It is the NASDAQ that continued yesterday sort of to be the big underperformer, and on an individual level as well. That shows it all.
There we go. Information technology down again today, and Taylor, thank you for that. We're down more than 1% on IT. Energy down about 2 percentage points. Crude a little bit softer, lighter, lower, negative on WTI again today. All securities on the S&P down about 0.75%. Got utilities firmer up by maybe 0.1%, call it 0.2%. That's where a bit of our performance is. It's a difficult moment. We're down about 5 days again. Down 5 days for the first time since the middle of July. Wall Street with one question. Where's the bottom?
The lead theme is that we end up retesting the June 16th low.
The market will be hard-pressed to really go too far below that at this point.
Our belief is that we do not set a lower low.
I think the lows are in.
We have about a 60% conviction that we saw the low back in June.
I wouldn't be surprised if equity markets go down a bit further from here.
That we're going to see a lot of volatility.
I've been looking for about 3,500, and the SPX is the rock bottom.
I think we will get through this okay.
There's a good chance that we could see 4,800.
I'm not for sure that I'm waiting for that second shoe to drop.
It will be a September to remember.
The market will bottom, and we think that's probably sometime between September and December.
Morgan Stanley's Dan Skelly joins us now. Dan, that was your buddy Mike Wilson. Just where is that June low?
Jonathan, good morning. So we think we're going to test that again in the next, call it 4 to 6 weeks. And I'll just say, with a nod to American football season coming back in the next month or so as the calendar turns to September, my coaches 25 years ago used to tell me to keep my head on a swivel. And I think that advice is incredibly relevant in the next month or so. You heard some themes from some of your some of the commentators earlier related to seasonality and liquidity. Let me just add 2 incremental comments that haven't been mentioned thus far, Jonathan. First, on seasonality, yes, September tends to be the worst month in general, but when you look at years in particular where the market was down leading up to September, the September average returns are actually even worse. And the second comment I'll make about liquidity, sure, we have the QT risk coming up, as everyone has talked about, but I think one development that hasn't been mentioned enough that Betsy Graysick at Morgan Stanley Banks Research has highlighted recently is that banks may also be de-risking balance sheets in the coming quarters to be more in line with Fed requirements on capital ratios. So that's going to add to the ambiguity in terms of liquidity.
So you think there's like a pro-cyclical type feel that the economy turns lower and these banks have to tighten up and it just kind of feeds on itself, Dan?
It feels like we're heading in that direction, Jonathan. In order to be more aligned with some of these requirements, you have risk to capital formation. You have some pressure possibly on credit here and lending. And look, that's on top of what is this kind of unknown, this known unknown emerging with the Fed's balance sheet shrinkage. So, Jonathan, that's not going to happen overnight. It's going to be a multi-quarter development, but it's something to keep an eye on. So to your earlier introduction, Mike was on a very lonely island earlier in January, and the island started to become pretty overcrowded in June. We had this massive rip higher. But we were cautioning people throughout the summer, unfortunately, that this was a bear market rally, and that's what it's looking to be.
Dan, dare I say there's no space left on that island? Everyone that comes on this program is almost bearish all the time. You're not a perma-bear, and I often remind people that you and Mike Wilson, in the depths of the pandemic in spring of 2020, were talking about a strong recovery in this market, and we got one. What would make you bullish again, Dan? What would make you leave that island, get on a boat, and leave everyone else behind?
Yeah, that certainly sounds fun, Jonathan, and I'll be sure to send you and the team a ticket as well on the boat. But what I would say is a number of things, right? First, we have to get some more capitulation in terms of the earnings picture lower, right? We've only seen 23 consensus sell-side earnings off 2%. And look, the reality is maybe some of the buy side is already there, but we expect those numbers to trend over the next quarter or two. So that's number one. We want to see a more reasonable and achievable level in earnings given this slowdown. The second thing I would say is, look, I think everyone is myopically obsessed with the Fed, whether it's 50 or 25, 50 or 75, et cetera. I think folks were too optimistic on a pivot coming earlier this year. Look, if we get a more dramatic economic pullback into the beginning of 23 and the Fed eventually does pause, that's a potential additional condition to get more optimistic. And then lastly, Jonathan, it has to do with the global picture. I think, look, given the news this morning, given updated lockdowns in major cities in China, given continued inflation pressures and commodities from the Ukraine-Russia stalemate, look, the global pressures maintain a huge overhang over risk assets. And so were we to see any relief politically in those spheres, that could also be obviously an upside surprise.
Dan, a lot to unpack there, and let's start with earnings. Earnings is the big focus for you. You mentioned that a moment ago. Mike Wilson's been on top of that too. Earnings, in a way, have been flattered by what's happened with the energy industry. Energy earnings have been so tremendous. Where do you think the earnings risk actually lies? Where do you think that's going to be concentrated, that weakness that you're looking for? Where will it develop in the coming quarters?
A really excellent point, Jonathan, and that is actually absolutely true. If you X out energy, next 12-month estimates actually came down about 5%. So you're right, energy has really flattered the overall picture. In terms of the risk, we're very focused on idiosyncratic over-earners over the COVID pandemic period, right? So when you look at areas like metal, autos, semiconductors, these are some areas that had really unique benefits during that period, where we're actually seeing not only costs continue to be higher, some geopolitical issues on supply, but demand now, right? And some of these issues cyclically might come under pressure. So those are some of the issues, some of the areas, some of the subsectors that had benefited in the last several years that may be at more kind of particular risk from margin degradation going forward.
Dan, do you worry that you might be later this year?
I think it's a fair point, John. I would just say, look, in terms of your whole dialogue earlier this morning, in terms of bad news, whether it's good news or bad, and I think that the takeaway is, look, when you look at the trends just this morning, NASDAQ and high growth stocks are still leading lower. And that's because the read-through of the stronger job update was that the Fed is going to go 75, right? So the pressure on that high growth cohort reasserts itself. And so that's a big deal, right? Because as you know, and everyone has talked about, growth is such a big part of the U.S. index that it makes it much harder for that U.S. index to kind of fight its way higher. So as long as growth is still kind of leading in one of the troubled areas near term, it's going to be hard for the index to fight through that.
I think this morning's dialogue's been utterly depressing. The first message I got about getting on that bullish boat was whether it would sink, Dan, given all the bad news we've seen. Dan Skelly's going to stick with us. Coming up, the job cuts piling up in corporate America.
When I look at the payroll report coming out tomorrow for August, I would expect a significant slowing in the pace of job growth versus July.
3M, the latest firm to announce job cuts. That conversation up next.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today.
We're going into this with an incredibly strong job market.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
We can't just rely on markets. We have to get our rate up to the level that will put downward pressure on inflation.
The employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting.
The data backs a lot of this up ahead of payrolls Friday. But looking at some of what corporate America is doing right now, you get a different picture. 3M, the latest, joining a growing list of companies cutting jobs and telling Bloomberg the following: the business can't avoid this tough necessity, adjusting to the challenging macroeconomic environment. And this means job cuts. Taylor Riggs has more. Hey, Taylor.
John, I'm curious if this is sort of trying to help us answer the question that you asked yesterday. How much of this is macro headwinds? How much of this is also a single company, maybe some of that execution risk, similar to what we were talking about yesterday with Bed Bath & Beyond, right? Because yes, there are some macro slowdowns, but there's also been some big legal setbacks for this company. I think a judge last week had said on a preliminary basis they couldn't use bankruptcy to avoid what could be 230,000 lawsuits related to some of the defects within those earplugs. RBI analysts were saying those settlement offers could be $8 to $12 billion in total. So there is sort of that push-pull narrative of the macro headwinds and then some individual issues affecting this company as well. I think what matters for our investors is you take a look at what has been one of the worst years now, going back since 2008. You're off about 30% or so. So this is a company that, yes, if we think about a bellwether for the economy, also struggling when it comes to the share price as well. Take a look, though, when it comes about job cuts. And I think what the economists are trying to sift through is you're getting some job cuts, but then you're getting jolts that are showing that there's still massive job openings. So what's the data that we look at? And the jobless claims, as Mike McKee knows better than anyone, shows that maybe things aren't so bad. So you tell me.
We'll see in payrolls tomorrow. Taylor, thank you. 298 is the estimate tomorrow for payrolls. The previous number, as you know, just blew up every single narrative out there. 528K was the previous read. Mike McKee's going to break it down for you ahead of tomorrow. Hey, Mike.
John, let me expand on what Taylor was talking about here. You take a look at the unemployment rate, and it is still way below where it has been on average going into recessions. It should be about 4.7%. That's the average since the of the post-war years in terms of where unemployment is when recessions start. We are a long way below that. What is the Fed watching? Well, there are about 5,670,000 people who are unemployed right now. At 4.7% unemployment compared to 3.5% now, that would be 1.5 to 2 million additional jobs lost. But if there are 11.2 million job openings, as Taylor was pointing out, in theory, the Fed believes they could easily find new jobs, the people who are laid off. And so we look at what is going to happen tomorrow, and we want to see, and this is a little bit of a complicated chart, but let me explain it here. The number in yellow is the number of people who have lost their jobs. The blue is the number of job openings, and the white line there is labor force participation, and it has fallen dramatically since the pandemic began. That has to go the other direction to absorb people who are losing their jobs to get them hired. So far, it hasn't. So watch labor force participation tomorrow and watch the number of people who are unemployed. The Fed thinks that should rise. They don't think it will be a major problem because of the number of jobs out there, but none of that is happening yet, even though they've raised interest rates by 250 basis points this year.
And Mike, what do you make of all this stuff, anecdotally, that we see from companies cutting jobs, making all these proclamations about what's happening with the labor force, and then you see the data and we're looking at 300K tomorrow and claims this morning just look fantastic?
It does look, as Taylor was pointing out, like a lot of it is sectoral or company specific. We're going to have to see broader job cuts that have to do with demand falling before we really get an idea of whether it is a company issue or a major national issue.
Is it execution or economic weakness or a bit of both? And Snapchat may be a good example of some of that. Mike, looking forward to the ISM breakdown that you're going to deliver in about 8 or 9 minutes' time. Going to break down some of the price action for you right now, about 21 minutes into the session. We are lower by 0.75% on the S&P. Another day of losses on the cards here on the NASDAQ, down by more than 1 full percentage point with some of the sector price action. Here's Abby.
Well, John, it is pretty brutal because we are, of course, as you were just mentioning, down for a 5th day in a row and down more than 6% on the S&P 500 over those 5 days. So that bear market rally clearly has come to an end. And relative to sectors on the day, it is not surprisingly bearish. The theme of the morning, we have most sectors lower. Worst energy down 2.8%. This, of course, as oil is back below $90 a barrel on demand concerns as China has shut down another major city. Materials also lower. Information technology down 1.4%. To the upside, you have communication services up about 0.6%, and then utilities and healthcare, both defensive sectors, higher. So those two being higher is not all that bullish. The stocks, though, that we've been talking about all day, chips, the stocks itself on the day down 3.5%. And this is extraordinary. Over the last 5 days, starting last Friday, John, down 13%. And of course, as we were talking about earlier, this has to do with NVIDIA and other companies struggling with both demand and those China shutdowns, restrictions relative to the U.S. and sales of some chips. One point I'd like to make, Citi is calling for that 25% decline. This index is already down 35%. That would be a 60% drop. And if I look back, the stocks in 2000 in that bear market down 84%. In the 2008 bear market, down 70%. That Citi call suggests that we might be doing something similar. So more bearish fodder for the day, John.
So many bears out there at the moment. Abby, thank you for that. Abby went through the last 5 days on the S&P 500. On the NASDAQ 100 over the last 5 days, down 7.5%. Off the back of this big move in the bond market. We add to it today, not at the front end though, at the long end, on a 10-year, after claims came out with a downside surprise. For me, if claims are delivering a downside surprise, I think that's the right kind of downside surprise. You want a decent jobs market. I know the Fed might be looking for something else. The 10-year was higher off the back of it by 4 basis points, breached through 325, right now 323. The dollar strength that we're seeing at the moment just slicing and dicing up G10. Sterling 115.65. That currency pair negative 0.5%. You've got to go back to spring 2020 for these kind of levels. For the monthly performance we saw last month from sterling, the weakest month, going all the way back to 2016. From New York, your trading diary. Up next.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth. And codifying that using AI, sensors, and computers is turning out to be a lot harder. Last but not least, it's a safety-critical system. None of us should deploy until and unless we have closed-loop evidence that we're safe.
Equities down. Here's the trading diary. ISM manufacturing at the top of the hour. Fed speak from Bostic, 3:30 Eastern. You hear from the president at 8 p.m. Bit of data coming up tomorrow. The main event is payrolls. Payrolls Friday from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now,
you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in prize sourced every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise
if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroid, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000. Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt.